Hello everyone, Radhe Radhe. In today's lecture, I'm going to revise all the concepts of the business valuation chapter for you in detail. And along with that, we'll also go over all the questions from the question bank that we solved in class for this chapter. I will also revise the special types of questions from that list at the end of this lecture, which is crucial to help you with your question solving skills. We studied this chapter in 4 parts. The first part covered Introduction to Business Valuation, the second, Approaches of Valuation, the third, EVA and MVA, and the fourth, Other Topics. I had mentioned that the second and third parts of this chapter are the most important for your exams because questions are generally based on them. So our main focus will be on these two parts. This was a very easy and quite short chapter and we covered it in our regular lectures without any issues. And now let's quickly start our revision. What are you to learn in this chapter? The first part, Introduction to Business Valuation, was created to explain its teachings. What is there to learn in this chapter? What is its purpose? For that, I created the first part for you, Introduction to Business Valuation. Let's understand what business valuation is. First, what is business valuation? Once you understand this, its purpose will automatically become clear. Essentially, business valuation means finding the value of a business. You need to find out the value of a business, that is a company. Find the entire company's value. Finding out the value of a company is the process that you have to learn in this chapter. And so in this chapter, we are going to learn the methods for finding the value of an entire business or a company. So why do we need to find the value of a company or a business? Did we have some free time so we'll just find the value for fun? No. We don't do anything just to pass the time, we do something only when we need it. So there is a purpose for valuing a business as well. What is the purpose? The main purpose is merger and acquisition. You are very familiar with merger and acquisition. You studied its accounting in intermediate under the name amalgamation. And at the final level, you will also study its accounting in FR under the name business combination. Let's say there's Reliance Limited. And since childhood, I've had a burning desire to one day make Reliance Limited completely and entirely my own. I want my control over Reliance Limited. This has been my passion since childhood. Essentially, my goal is to acquire Reliance Limited, which involves undertaking a proper merger and acquisition. So if I want to make Reliance Limited my own, if you want to make anything your own, well, nothing comes for free as it costs money and therefore I will have to give some consideration to Reliance Limited. How much consideration? As much as its value is. The value of the Reliance Limited signifies its overall company or business value. So you understand the purpose is to find the value of the business because I want to make Reliance Limited my own. I will need to determine the value of Reliance Limited, that is its entire business and company, so that I can give that much consideration and make that company my own. Did you understand this? This is the same thing you do in the accounting part of amalgamation and business combination. We certainly study this in the accounting subject. We're also studying this in FM. What's the difference? Is it the same? No, because we often forcefully link everything. Did you get this? As we think both topics are same to study, but that's not. Both subjects are different in their own right. I always say this. You should never try to link one subject with another. Accounting is separate, this subject is separate. In accounting, the amalgamation, business combination, merger or acquisition has already occurred. After the merger and acquisition, you handle the accounting part, you record it by passing entries in the books. And here also the merger and acquisition hasn't happened yet. We are in the pre-merger phase where the transaction is still being planned. It is in process. Right now we are just finding out its value, how much consideration should be given. We are in that process. The merger hasn't happened yet. What exactly is financial management? It's a decision-making subject, and here you first undertake all the valuation work for the transaction. You do the working within the process to get it all completed. So this is the pre-merger phase that is being dealt with in this subject in FM. Once the merger is done, the post-merger phase will move to the accounting subject because you have to pass entries there. So I have clarified this beforehand so you don't have this unnecessary doubt. Now another purpose for business valuation is the sale of business, which is the opposite of what we just discussed about buying a company. But this time I want to sell my company. I want to sell my own company. For how much should I sell it? I'm going to collect money from people, but how much should I take? For that I have to tell them the price. So I will first find the value of my business and then I can say, give me this much money and take my company. This is one purpose, and another key aim for business valuation is strategic decision making. Now you want to implement a new strategy in your business. You decided that I will manufacture this product and not that one. I will do marketing this way, production that way, meaning you now want to apply a new strategy in your business. So now you have to then make an important decision. Should I implement this new strategy in my business or not? So how will you do that? You will see the benefit and we will learn all this in detail in this chapter. So for strategic decision making also you need to calculate the value of your business, which I am going to explain to you in detail. So in this chapter, you have to learn to calculate the value of a business or a company. And the main reason we need this skill is for the purpose of mergers and acquisitions. Got it? Now let's move forward. Basics of business valuation. Your introduction phase of this chapter is still ongoing. We are looking at the introduction to business valuation, and I've explained its meaning. As I told you in regular lectures, this introductory part doesn't generate exam questions. These basics I have developed and given them to you so you can get help in solving questions. No direct questions come from these, understand this. The basics of business valuation, meaning you'll now learn how to do the valuation. So before you learn to do business valuation, learn some basic things. There are some basics of business valuation. If you don't know these basics, you will never understand this chapter in your life. Let me tell you the basic things I am about to tell you. Many people in the market, many students and those who are practicing it, they usually get mixed up in these basics and just don't understand why this method, formula or equation is being used. Because their basics of this chapter are not clear. Study the basics of this chapter. After that, you will have a good command of it and understand everything. Before studying business valuation, you should know the basics. Some basics were there which were going to be useful throughout your entire AFM study. When the batch started, we first talked about those basics and we dedicated the first 2 lectures specifically to that, so that they will be useful when you study the entire AFM. But now these are chapter specific basics and you must know them before studying business valuation. Now what are these? First of all, the first thing is the firm's value, which you also call as enterprise or business value. What is that? See, first let me make this basic clear to you. What does business value mean? The value of the entire company. The value of the company meaning the value of the firm. You can also call it the value of the firm. Firm value means the entire entity, which is the enterprise. Value of the firm, enterprise value or value of business all mean the same thing, and you must remember this. If the question asks for the value of the firm, enterprise value or value of business, all three will have the same meaning. They are used as synonyms. In practical life, we generally use the term value of the firm, and in the exam too, we will generally study using the term value of the firm. We will study according to the term value of firm, meaning the value of the entire company. So what is the value of the entire company? Now you will say, I should tell you and explain it. How will you calculate and do the valuation? I will explain that, but for a moment, think at your own level what the value of the entire firm would be. If you have to find the value of the entire company, what will it be? I will explain with an example, you will understand easily. So what is the firm's total value? I wanted to make Reliance Limited my own. Since childhood, I had this obsession to make Reliance Limited completely and entirely my own. My own. Meaning I really do not want anyone else to even look at it or touch it at all, because I intend to make it completely and entirely my own. No one else's eyes should fall on it. I don't want anyone else to look at it. If I want to make a company completely my own, what will I have to do? So should I buy all of its equity shares? If I buy all of its equity shares, the entire control comes to me and no one else will be in the company. So I should take the value of its equity holders. Take the value of its equity holders, which is considered to be value of equity. But with just the value of equity, have I gained complete control over entire company? I have gained control, but some people can still cast a glance at it. It hasn't become entirely mine. Why? Because it's possible that Reliance Limited has taken a loan from the market. It might have raised money through debentures or bonds, which you know as debt. Reliance Limited has also taken on some debt. For its operations, a business takes money from 2 sources, equity or debt. I had told you this for the purpose of FM. If you are considering preference shares, discard that thought. For FM, they are irrelevant, they aren't used practically. So, Reliance Limited must have raised money from equity and from debt. I have made the equity my own. But its business also has some debt from where it had raised money. If the business raised money from debt, the debt holders would interfere in its operations, often dictating terms. Since they have given a loan and then invested in the business, they will interfere. And I want to make Reliance Limited completely my own. I don't want to see a single outsider. If I see any outsider, it bothers me a lot. What should I do? Pay off the debt holders, tell them, here's your money, now get out of the company. It's because I want to establish my complete right over it. So that means value of equity plus value of debt. Pay the equity holders and make the equity my own. Paying debt holders and removing them means the entire company's value. Equity and debt together, isn't that the entire value of the company? It was their money invested in the company. So this is the company's value. But listen, now listen to one more thing. As soon as I got control of Reliance Limited, I paid the equity holders, I paid the debt holders. As soon as I paid the money, I became its boss. The crown of that company has now come on my head, meaning the entire control of that company is in my hands. I can do whatever I want with that company. Not a single person can come and say anything to me because now I have complete control. As soon as I got complete control of that company, listen to what happened. That company had a safe. That company had a safe in its office, and it turns out there was some cash inside that safe. It could be in the form of cash or a bank balance, that is cash and cash equivalents. Tell me, once I controlled that company, who owns that safe? Me. That safe completely became mine. I mean, I paid its equity holders and paid off the debt holders, so the entire company is now mine. As soon as the company became mine, its cash balance in the safe and bank balance, meaning all cash and cash equivalents, became completely mine. So I made a payment just to make the equity and debt my own. And after making the payment, when the company became mine, the cash and cash equivalents that were in its safe came to me. So ultimately, what is the value of your firm? Value of equity plus value of debt minus surplus funds, which are cash and cash equivalents. Cash and cash equivalents are called surplus funds because money is not invested in business. If invested in business, it's in assets. Then it would have been invested in your capex or somewhere else. This money sitting in the safe is surplus, thus cash equivalents are surplus funds. This money came back, I mean, I paid the equity and debt holders, but I got control over its safe, so I got that money. Thus, after that deduction, you get the firm's value. This is your business or enterprise value, which is the firm's value. You've shown the value of the firm right here in the basics of this chapter. You say we still have more to discuss, but you've already given the formula. So is the chapter complete? The chapter is not complete yet. This is a basic equation, not a formula, and you will call it a basic equation. What its role is, you have seen in the regular lectures. Now in the revision, I will revise its role for you once again. Now what about the exam? What's there in exam and in practical life? First, let's talk about practical life. If I talk about practical life, then you have a company in front of you and that company's balance sheet. You have liabilities and assets. On the liability side, it has raised 1 crore from equity and 50 lakhs from debt. The money is invested in the business. And on that company's balance sheet, I'm talking about Reliance Limited in my example. I want to make Reliance my own. And Reliance's balance sheet shows cash of 20 lakhs, which is a surplus. So look, in practice, you'll have the company's balance sheet. So you know how much cash balance it has, that's fixed. Whatever is showing on its balance sheet, whatever is in its safe. You can also see the debt balance of 50 lakhs to the debt holders and the liability is settled. That's it. But in practical life, the equity balance isn't directly available because the balance sheet shows equity of 1 crore. Well, that's the share capital, which is just at the face value. When you purchase Reliance Limited shares from the equity holders, will you tell them to take only 10 rupees face value for them? They will tell you to forget the 10 rupees as face value doesn't matter, only fair value. So you need the fair value of the equity holders' stake. This is the point in the exam too. If the company has cash, it will be given. If the company has debt, its balance will be given. There's no issue with that. You have to calculate the value of the entire firm, the whole company, right? You just have to do the valuation of equity. You will need to find the value of equity. You will need to do a valuation of equity, for which there are many methods that we have to study in this chapter. I'm saying many various methods. In this chapter, we must study various methods to calculate the value of equity, and we need to determine the equity holder's stake value. Once you get the value of equity, the debt or cash balance will be given in the question, and it's also available to you in practical life. Next, calculate equity value, and debt and cash are available. Just plug the data into this equation and you will get the value of the firm because it is a basic equation. The major part we have to study in this chapter is calculating the value of equity. How to calculate it, for which there are many methods. The second part of this chapter, approaches of valuation, will cover these methods. Approaches mean methods. Here you study methods for equity valuation. So as soon as I say this, a point will come to your mind that you studied something like this before. It was in the security valuation chapter. In the security valuation chapter, we found an equity share's value, determining its fair and intrinsic worth. What we did was calculated it in that chapter. So are the methods for equity share valuation in the security valuation chapter the same methods you are going to copy and paste here? Look, here a different method is used. We will study something different here than in that chapter. So what is happening? You are discussing valuing equity shares in both chapters, and there is a difference, so listen carefully as this requires detailed knowledge, which you should know, otherwise you get confused in the exam, and then anyone can tell you anything like the paper is tough, this, that. Listen, what happens is, in security valuation, our purpose was different. We didn't want to acquire any company. There I was an investor and trader. I had to buy 10, 20, 50, 100 shares of a company. So I was just checking whether I should invest in this company's shares or not. Is the company's share overvalued or undervalued in the market? Should I buy or sell the share today? You used to do valuation of equity there for this decision-making purpose. And in this chapter, your entire purpose has changed. In this chapter, your purpose is to make the other company your own, to buy the company in front of you. You do the equity valuation to buy. When your purpose changes, your thinking automatically changes. And then because your thinking has changed, the method itself must also change. It's all about the purpose, because your purpose fundamentally determines how you work. If your purpose is to get a rank in the finals, you will work hard accordingly. If your purpose is just to scrape by with 40-50 marks and pass, then you will try to find some shortcut. If purpose is just to fail, then you will simply fool around. It happens that some people choose to fail. You might wonder how. Don't take it personally, some are like that. Don't worry. Your study purpose watching this video shows dedication. Alright then. So this is the basic equation. Remember, value of firm. This is not a formula, it's a basic equation. As debt or cash balance will be available to calculate value of equity using various methods. Put it in this equation and get value of entire firm. Is it clear? Now see what happens sometimes. Sometimes what can happen in a question. The question will provide the firm's value and it will also state any debt or cash. Calculate the value of equity. So use your brain a little, use the basic mathematics I taught you in basics of AFM. The basics of AFM that I taught, you should study that first. Revise that first or you won't be able to do anything in any chapter, because it contains the entire crux that will be useful in every chapter somewhere or the other. So you can apply basic mathematics here. You have this available and this available. Can you calculate the value of equity? I've taught you to solve equations in basic mathematics. What is the value of equity? Start with the firm's value. The value of debt moves to the other side becoming minus, and the minus also shifts becoming plus. So minus value of debt and plus the surplus fund or cash, giving you the value of equity. This gives equity holders value. I can use the basic equation. I haven't made a new formula. The value of equity was derived from that same equation. You will use this when the question provides the firm's value, or it gives you the value of debt and cash balance and asks for the value of equity. Then apply this and your work will be done. Did you understand this? You shouldn't have any problem with this. It also has another role. What happens sometimes in a question? Imagine I want to create an imaginary situation in your mind. You are given data in question. Extensive data is provided and it asks for equity value. Based on the given data, you will teach us methods. We will apply one of them to get the value of equity. You'll do this. If debt and cash are provided, we calculate the firm's value. Here is another question in front of you. You are given the data normally like this for all calculation purposes. After this, you are given the debt balance, the cash balance, and you are asked to calculate the value of equity. You will learn equity valuation methods we will employ. The methods I will teach, none of those methods can be applied to this data. The kind of data given in this question, you can't apply any of the methods I'm going to teach you to that data. Tell me, is the question wrong? It's not. I will teach some methods like that. I will teach methods in this chapter that will directly teach you to calculate the value of the firm from the data. There will be some methods that will directly give you the value of the firm from the given data. In this case, the value of the firm method will be applicable, which I will teach you later on. Applying this method will provide the firm's value. And once you get the value of the firm, if the debt or cash is given, you can apply it to this equation. So this was the essential point that you should understand clearly. If this isn't clear, you will never understand the chapter, because it's a point no one else is teaching. I wanted to tell this. The value of the firm, also called enterprise or business value, is equity plus debt surplus. For equity valuation, various methods will be applied, and then putting into this equation, you will get the firm's value. Similarly, equity value is firm value minus debt plus surplus. Various methods to calculate the value of the firm, which I will teach in this chapter, that directly give the value of the firm. So inputting that data will give you equity value. Now there is little left in the basics. After this, if you are asked for the value of equity per share, with the methods I will teach, you can calculate the value of equity. Divide that by the total number of equity shares in the company. Then you will get the value of equity per share. What is the value of one share? You will get that. That's it, finished. Next point, if there is no debt and surplus fund, cash and cash equivalents, then value of firm is equal to value of equity. What is this then? Look, if the company has no debt and no cash, imagine in practical life a company with no debt. That company has not taken any money from debt, nor does this company have any cash and cash equivalents. So what will be the value of the firm and equity for such a company? They will be the same. When there is no debt and no cash, put it in the basic equation. When debt and cash are zero in the basic equation, the firm's value will equal equities, and it's mathematically proven. Think this firm only has equity. Its equity holder's stake is the entire firm's value. So for a company that has no debt and no cash, the firm's value will be equal to the equity value. Such a question comes in the exam. But the exam question doesn't tell you the amount of debt nor how much cash the company has. So understand it has no debt and no cash, just make that assumption. Now if you say that I will forcefully assume there is 10 lakh of debt and 5 lakh of cash, then that will be foolishness. Never make this mistake in your life, no matter how much wisdom someone tries to give you. There are many such people in the world, don't apply their wisdom. If you apply your wisdom, then the institute will apply its wisdom and give you 0 marks. Avoid baseless assumptions. If debt and cash aren't given, company has no debt or cash. If a company has no debt and cash, then its value of firm and value of equity will both be equal. If the question asks for the value of the firm and the method is for the value of equity, then the value of equity will be the firm's value because there is no debt and cash. Knowing these basics is most important. Moving to the last part of the basics, we'll cover company's cost of capital, also known as weighted average cost of capital or WACC. You've studied this in intermediate and it's very useful here. I want to tell you it's not part of your final syllabus. This WACC is not part of the syllabus, so you won't be asked to calculate it, but its application is required. How it will be used, I will tell you all later. You should know how to calculate WACC, the company's cost of capital. I'll explain this with just enough relevance for our purpose because it is not on the syllabus. So what does cost of capital mean? For FM, you don't have to think of capital as equity capital. Here capital means capital employed. A business needs funds. As a company, I must invest in my operations. I raise money from 2 sources, equity and debt, and then I invest this money in the business. A simple process. So equity and debt, this is my capital employed. I wrote this down in the basics of AFM. I take money from equity and I also take money from debt. This is the capital employed we are discussing. So this capital employed that I have taken in the business, the money I have raised, what is my actual cost on that money? When you raise money from the market, you will find you don't get it for free because you always incur a cost and you have to bear some cost on that money. You simply have to state that cost, which is precisely the business's cost on capital. So the cost that a business incurs on capital is called the WACC, which is denoted by KO. K means cost, O means overall. Cost of overall capital, okay, overall cost of business. How to calculate? What is the cost incurred on equity and what is the cost on debt? We formally define the cost of equity as KE and the cost of debt as KD. This is your total capital cost. If we add KE plus KD, we will get the overall WACC. In KE plus KD, you have just simply added them, whereas cost is in terms of percentage. You cannot simply add them. Why can't we simply add them? Look carefully. So here, let's revisit the example that was just presented. In this example, I had raised 1 crore rupees from equity and I took 50 lakhs from the debt holders. Now tell me my cost, the cost I will incur on equity. It will be on rupees 1 crore. I have to incur cost on rupees 1 crore and on debt holders on rupees 50 lakhs. The cost that I calculate is in percentage terms per annum. So I cannot simply add the cost of both as they are. I will have to do a weighted average. I will have to take weights, which involves giving the weight of equity out of the total capital in the company. And for the debt cost, how much debt is there in the company out of the total capital, give its weight. So you will have to multiply cost of equity by weight of equity plus multiply the cost of debt by weight of debt to get the WACC. And if you're thinking about preference shares, I've already said they don't exist here and you won't find them, so don't overcomplicate it. Now, as I've explained, KE is the cost of equity and you calculate it using CAPM. RF plus beta of equity, RM minus RF. The logic of this equation was covered in portfolio and equity valuation. Revise it from there. We explained it over 3 to 4 hours in regular and revision videos. So you have to revise this thing from there. I am not going to explain that again here. That's why I say do it in sequence, because my lectures are all connected and not just something that I've picked up and copy pasted. We don't have to do that kind of thing. After this there is KD. KD is the cost of debt and the cost on debt is always considered post-tax. What is the cost on debt? It is the interest rate you pay to debt holders. But as soon as you pay the interest on debt, that interest is allowed as a deduction in income tax. It is allowed, meaning you get an income tax benefit, the expense is allowed. This means you get a rebate of your tax rate on the interest amount. So what is the net expense? Interest rate on debt times 1 minus tax rate. This net expense KD is debt cost. Paying interest on debt creates tax savings, and so you should take the net expense that you are actually incurring. W is weight of equity, which is E divided by E plus D. Weight of debt D divided by E plus D. Here E is total equity. Equity share capital plus reserves and surplus. When we talk about equity, reserves automatically come with it because reserves belong to the equity holders. Taking that is in a way taking the net worth. Now you remember this point. If the question gives an intangible asset like a patent, not recorded in the books, what happens sometimes? There are some intangible assets that a company cannot record in its books for any reason or due to accounting rules. But they are their intangible assets. Include that as part of net worth. Why is it part of net worth? I also taught in the basics that net worth is total assets minus total liabilities. If this intangible asset were included in the books, total assets would rise. So you add it to equity, which increases the equity holders' claim and the net worth. How do you get D? That is debt. Long-term debt means company borrowings, debentures, long-term loans. Take note of this in weight. Whenever I talk about the weights of equity, debt, etc., remember that in every chapter in different topics, the weights change slightly. You have to remember this. I have said this many times before. When we talked about asset beta in the portfolio chapter, we had to take weights there too, but it was done differently. And within this chapter, weights will be used in various places and they will differ. Remember that, then details later. Let's talk about WACC. If the question has long-term debt, you know the question gives long-term debt, but the cost of debt is not available. KD is not available. So how to calculate WACC? Then our great institute calculates WACC directly from CAPM. The formula is RF plus beta of asset times RM minus RF. Beta of asset meaning the assets beta, which is explained in detail in the portfolio chapter, so revise it from there. What do we call the asset beta? You know, it represents business risk. So what does the institute think? In the CAPM equation, the equity beta yields KE, which is the cost of equity. Since equity beta assesses equity risk, the cost of equity. So if we put the entire business's risk in this equation, we will use the business's risk, which means the beta of the asset. We should get the business's cost. The cost of capital, the entire company's cost of capital should be obtained. So the institute just solves it easily when KD is not available in question. We know the company has debt, but the cost of debt is not given, so it uses this. But let me tell you, this method is not correct at all. This method is wrong, which the institute is following, so we will do it. Because the WACC answer from this method. Both answers from these methods will differ. Because this method is not for WACC. The CAPM equation is for calculating the cost of equity, the required return, not for calculating the weighted average cost of capital. This method is completely wrong, but the institute follows it for questions where KD is not available, as there is truly no other choice left. Only then will we use this WACC formula, and generally you should be calculating the WACC using this normal formula. If a student thinks I have less time, I'll use this shortcut in the exam. Their marks will also come in a shortcut. So you have to keep this in mind. With this, we have studied the basics part of this chapter. This was the most important part. Your basics should be strong. With strong basics, you'll avoid chapter problems. Because you should know the basics first, since most students genuinely don't know these basics. I can say this to you with a guarantee. Those who haven't studied or listened to this lecture, who are not my students, 90% wander around in this chapter. Many mix things up and lack clarity, and this applies to teachers too. Let me explain the current situation. As much of effort has gone into these notes. Now look, the second part, approaches of valuation, is this chapter's most important section. Most questions originate here, as approaches signify valuation methods. We have to study many methods in this chapter that will teach you to calculate the value of equity. And there will also be some methods that will directly give the value of the firm. So we have to learn all those methods in this part. So how many methods are there in this part? Approaches of valuation. Methods will be discussed later. First, 5 models. You have to study 5 models, which will be the basis for your valuation. There are 5 models that you will use to do the valuation. And within each model, there are 2 or 3 methods. Overall, you can assume you have to study 10 to 12 methods in this chapter, from which all our questions will be solved. It's very easy if you understand it logically, which if you did in the regular lecture, you wouldn't have faced any problems. But here I will revise this in full detail, allowing you to make that complete linkage. So we will learn those methods. So before teaching these methods, I want to discuss a few more things with you all that are important for you to know. It will clear all your logics. These points aren't examinable, but I'm explaining them here. So first of all, I will teach you many methods. There are various methods for calculating equity's value. As I told you, and I'll teach you 6 or 7 methods for equity valuation from which its value is calculated. So for all the methods of value of equity that you are going to teach us to calculate the value of equity, will every method give the same value? You will not get the same equity value. Unless it's coincidental, every method will give its own different value. You will get a different value from every method. It cannot be the same. Anything can happen by coincidence. Otherwise, the value from the methods will be different. For all the value of firm methods, the firm's value from each will be different, though coincidentally it can be same. Each method will have its own theory that's based on its own assumptions. Have you understood? Because every method possesses flaws. You see, every method has flaws which has led to new methods emerging in the market. Then you should directly tell us the method that has no flaw and gives the most accurate value. Understand this. No method in practical life is without flaws. I will teach you and you will grasp it all. There is no method that doesn't have flaws. Every method has flaws and no method can ever give a completely accurate value. This valuation part, business valuation, is a very complex task in practical life, a very subjective task. Nothing is truly fixed in this. For the exam, this is the easiest provided you have logically grasped my formulas. In practical life, this is very complex. You will gradually understand this. None of this is accurate and perfect. So which method is actually used for valuation in practical life if you are saying no method is truly accurate? Every method gives a different value. In real life, companies calculate the value using 3 or 4 methods. For instance, for equity valuation, they use 3 to 4 methods. The equity values from all those methods are averaged and that average is considered the final value. How should we approach exam? In the same way. In the exam, do exactly as instructed. If the question specifies a method, then just apply that method and don't overthink it. If a question doesn't specify the method, then should we choose? No. Look at provided data in question. Looking at the data in the question, you understand which method to apply. You'll understand it by looking at the data, and the question's information makes it clear. And if you still can't figure out which method to apply, then the fault is entirely yours. It's no one else's fault but your own because you haven't studied properly. If you had studied well, you would know which method to apply just by looking at the question. If you have studied, it's simple. So it's easy for the exam. If the question asks you to average the value from 2 methods and consider it the final value, then you must do that. Basically, whatever the question says is final. Don't use your own logic beyond that. This was additional information. Now let's start our valuation. The first model is market-based, a very easy one. There's nothing to the market-based model. You get the data from the market. What did I say? There are several models for your valuation. There are 5 in total and the first is market-based. You must take the company's market data to determine value, and the initial method in this market-based model is the market price method. This method must have crossed your mind many times while I was giving the explanation. What does this method say? Find the market price of the company's share. Market price is for the share. Determine the share's market price and multiply that market price by the number of equity shares. Will this method give the firm's value or the equity's value? You can now judge whether this method gives the value of equity or the value of the firm. You don't have to rely on anyone. I am explaining this. As I teach this method, I will also tell you where students usually get the most confused. Many students studying this chapter don't know if this method gives equity or firm value, and that's logical. And I can tell you, even the instructors are confused. Nobody knows how to teach this chapter. It's randomly handled. I'll explain the reality. This chapter is poorly presented because the institute's module is a complete mess and you won't find the structure I'm giving you anywhere in it. In every aspect. Multiply MPS by the number of shares to get the value of equity. This simple method offers free exam marks. This method directly gives the equity value and you understand it's MPS times shares. This method yields equity value. If firm value is asked, how is that calculated? Your basic knowledge applies as I link concepts. Given MPS and shares, you're asked for the firm's value. So is the value of equity from this method wrong for the question? Calculate equity value using this method. The question usually provides debt, just add that and cash to subtract. This gives the firm's value. With no debt and cash, both values are same. The basic equation applies at the end. You must know that basic equation to understand this chapter logically. Then you will see the linkage. Everyone keeps creating confusion in this. They keep mixing things up. Even those in practical life, they also mix things up despite their knowledge. They possess perfect knowledge of what is calculated, yet they often get these things mixed up. No one is explaining it in a structured way. That requires a lot of research, which I have done and provided for you here. Second method in market-based model, PE ratio method. The PE ratio method is essentially a market price method variant created by the institute, not truly separate. What is this PE ratio method? To calculate the value of equity, you need the PE ratio MPS by EPS. You learned this in the basics of AFM. So to find MPS from this formula, how will you do it? PE ratio into EPS. Using this method, you directly calculate the value of equity per share by multiplying the PE ratio by EPS. This method calculates total equity value. How will you obtain total value of equity? Instead of multiplying PE ratio by EPS, multiply it by total earnings for equity shareholders. Formula for PE ratio is MPS divided by EPS. Then multiply the numerator and denominator by the number of shares. MPS multiplied by the number of shares equals total equity value. Multiplying EPS by total shares yields the earnings available to equity shareholders. You can directly calculate the total value of equity according to what is asked in the question using this method. The market-based model is simplest and easiest. They are fundamentally pointless. Other models are easy. These are trivial. Market-based model is complete and questions are easily solvable. Now look the market-based model. You said that every method has a flaw, every model has some shortcoming, and that's why new methods kept emerging. What were the drawbacks? They seem fine. We'll discuss shortcomings. First of all, the market price method and the PE ratio method are both the same method and they both use the market price. Both methods share shortcomings. What is the flaw? Well, here it is. Market price per share. If I have to value a company that is listed on the market, there's no problem. Take value of its equity. But suppose I have to evaluate a company that is not even listed on the stock market. Without a market price for unlisted companies, this model cannot be applied. There is a second flaw in this method. What is that flaw? The market price per share is driven by demand and supply. Suppose a company is in ruins, it has no assets or anything. It barely has assets worth 50,000 rupees. But in the market, its demand has been inflated by traders whose business solely runs on the market. Whether their business runs or not, those who pass their time in the market. They inflated demand, driving prices to 2-3,000 rupees. In the market today, a company with assets worth only 50,000 rupees has shares trading at 2,000 to 3,000 rupees, which they are not worth. This is completely wrong because it's due to inflated demand and supply. One day they will sell the shares and the price will fall and be wiped out. This means the market price does not reflect the fair value. Would you be willing to pay 2,000 to 3,000 rupees per share for a company that is completely ruined? The market price never reflects fair value. It's driven by demand and supply, so it's not a correct measure. This indicates many flaws in the market-based model. To rectify this, the asset-based model was introduced. A new model came, the asset-based model. Why did the asset-based model come? Because we just discussed it, and what's the issue with market price? A company with no assets can have a high share price, so it won't give the correct value. To resolve this, we will use the company's assets as the basis for valuation. If we have to value a company, we can make its assets the basis. Let's make its assets the basis. We can perform the valuation based on its assets. We should rectify the flaw found. You'll find this chapter completely structured. I teach every chapter in a structured way and it applies here. The most important thing in this chapter is being able to link these concepts. Now, asset-based model. The first asset-based model method is the net asset value or book value method. What does net asset mean? Find out the net asset value. Net asset value means total assets minus total liabilities. Take the company's total assets and subtract all its liabilities, the total liabilities. So that will be the net assets, which you also know as book value. It's also called net worth. Go back to the basics of AFM. If you subtract total liabilities from total assets, what's left is the net worth or book value, which is why it's also called the book value method. So net worth or book value belongs to the equity holders. Yes. What value will this method give? The value of equity. Your concepts need to be clear and you'll know what value it provides. This method will give equity value. This method gives equity value using net assets at book value. Meaning, how do we calculate net assets or net worth? It's total assets minus total liabilities, and there's another shortcut as well. Capital, reserves and surplus. Equity, capital and reserves plus surplus give the same result. Are you thinking? I have explained this in basics. This is balance sheet of the company I need to value. The liability side has equity, debt and other liabilities. And for net assets, you begin with total assets minus total liabilities. Subtract all liabilities including debt. The value for equity holders will be left, meaning share capital plus reserves and surplus. Reserves and surplus always remain with equity, as their right belongs to owners, that is equity holders. I explained this during the basics, we won't repeat that again. Equity, share capital plus reserves and surplus. Keep one point in mind. For business valuation purposes, if you apply the asset-based model, you have to subtract any contingent liability the company might have. If there's any contingent liability, it must be subtracted. Why do we do this? Listen carefully. When I went to buy Reliance, I had to find its value. I used the net asset value method, subtracting the total liabilities from the total assets on its balance sheet. Okay, then my eyes fell on a footnote below the company's balance sheet. The footnote showed a contingent liability. It never appears on the balance sheet, which you should know as a final year student. And if you don't know, then that's a serious problem. You will face difficulties. The contingent liability in the footnote, which I observed, I informed the other party. Their books showed a contingent liability, not actual liability yet. But if this converts into an actual liability in the future, then it's a loss for me. I will have to pay the liability because if I buy your company, it becomes mine too. Understand? Now you must treat this contingent liability as an actual liability from today itself. Treat it like actual liability and subtract it from this. So when determining the actual liability, we subtract all liabilities from total assets. and you must treat the contingent liability as an actual liability, subtracting it here. If it's given in question, keep it in mind. So this is the asset-based model, the net asset value method. This method is quite easy. There is nothing complex in this chapter. If you study logically and correctly, everything is easy. Otherwise, if you really want to make it tough, you can definitely call everything tough. And some people feel happy calling this course tough for their own satisfaction. And because of this very reason, they never get the satisfaction of becoming a CA. So that's your choice. This is the method. The questions are based on this. Now, before we study the next method, let's talk about the flaws of this method. I said every method has a flaw. So what's the flaw in the net asset value or the book value method? The biggest flaw is that the net assets, meaning the total assets, are taken at their historical cost, which is the amount shown in the balance sheet. And the amounts taken from the books are called book value. I am taking amounts as they appear in the books. Why are you then taking historical cost? The market value of assets must have changed and you should take them at their current value. If these assets had to be sold today, what money would be received? It's better to consider that or the book value. You should consider what you would get today, the money from selling them. That's what will reflect the real fair value. So to overcome that problem, a new method was introduced in the asset-based model, the net realizable value method, which you also call the liquidation value method. Use the amount you would realize from these assets. This means what money you would actually get upon selling them. It's essentially talking about market price. This method will give same value of equity. Basic logic is same. Take net assets, that is total assets minus total liabilities at their realizable value. The realizable value of a liability is the same as its book value. Assets have a different realizable value. A liability of 100 crore in books means that exact amount must be paid. That's it. But assets are at historical cost in the books, and this method requires using their fair value. So in this, what you will do is first take the net assets at book value from the balance sheet. Take this value as it is, equity share capital plus reserves and surplus minus contingent liability. Take this as it is first. So now we have taken the net assets at book value. Now convert it to fair value at realizable value. Now consider this. Is there any asset in the company's financial books that upon selling will realize an amount greater than its recorded book value? An asset recorded at 100 rupees, and if I sell it today, I will realize 150 rupees, getting 50 rupees more than its book value. So you must add this extra amount because we have already taken the net assets at book value and are now adding the surplus realized from the asset. If an asset's balance increases, net worth will increase. Besides this, is there any asset which upon selling will realize an amount less than its book value? And for the amount that is realized as less, you should subtract that value. For example, suppose an asset is in my books for 100 rupees. If I sell it today, I will only get 80 rupees. I'll get 20 rupees less, then subtract 20 rupees from this. The asset was listed at 100 in the books and it should have been at 80. So with this method, you will get the value of equity. These were very easy methods and the asset-based model is also finished. You can see it was completely easy. So that's the point in this. If you understand this chapter logically, you won't face any problems. So this point is also complete. And now after this point, the net realizable value. I have explained the net realizable value to you. So what is the flaw in this method that we have to move on to another one because there are more methods ahead. So the net realizable value method also has a very big flaw. A very big flaw, a very major flaw. I will explain it with an example and you will be able to link it very easily. Let's talk about my coaching institute, the AIR1CA Institute. Suppose this is my coaching institute and you want to do its business valuation because you feel like buying the AIR1CA Institute. So you use the net realizable value method. You said the market price is useless, you will use the asset-based model. It's the net realizable value at market. You calculated the value based on your net assets. Do you know what value you actually found? What assets would be in my business? There would be a writing pad, a PC, a camera, and what other assets do I have in this business? My business has limited assets and you calculated the value as 1.5 to 2 lakh, at most 2 lakh. The asset value is not more. So you said you have applied the net realizable value method for your business. But your business value is coming out to be rupees 2 lakh. If you offer 2 lakh rupees to transfer this business to your name, I would tell you I don't want to do it. I will be like, whatever the value of my business is, it's not 2 lakh rupees. You already know that and I know that too. My daily business expenses are 2 lakh rupees. That's just costs, let it be. Did you understand? So where did you make the mistake? You made a mistake by choosing the wrong method. Because my business, it's a certain type of business and there are some businesses like this. They have fewer assets with limited number of assets. But those businesses have a very high income or earning generating capacity. There are some businesses whose assets are very limited, but their inherent capacity to generate income or earnings is actually very high, and I simply did not consider that crucial aspect. The asset-based model only considers the business's assets, but it doesn't consider its capacity to generate income or earnings at all. My coaching business, you see, has limited assets, but my capacity to generate income or earnings on which my valuation should truly have been based. That was not even considered. The main factor is how much income or earnings I am generating in my business. My business has hardly any assets. It's not an asset-specific business where my business runs on assets. Are you understanding? So this method cannot be applied to me. This was the flaw in this method. So what do we have to do to fix this? The next model we have is income or earning based. Alright, this had a flaw. We were not valuing based on income or earnings. So now take the next method. The next model was created income or earning based. New people in the market proposed their theories, identifying existing theories' shortcomings. From this, new theories emerged, and people suggested valuations that would be based on income or earning models. As I'm linking everything, we started with the market-based model, and its flaw meant we should use assets as the base. So we then moved to the asset-based model. The flaw meant income became the base, leading to the income-based model. Everything is in a structure. I might take a couple of minutes here, but I am telling you to simply follow the structure that I am giving you. If you follow this, you will face no problems because the most important are concept notes. If you follow this, you will never fail in questions. Memorize the concept notes, as students often directly solve questions. Change the habit of directly solving questions. You watch some random video on YouTube solving a question and you feel happy as it's free. They are helping you fail for free. Because they solve 1 or 2 questions, and if the exact question comes, you'll copy it. But you'll be in trouble if it's slightly adjusted. And then they'll ask how to solve 5,000 or 10,000 questions. Then they tell you the paper was tough, and then I say the paper was easy because I know the paper is normal. So that's your mistake. You have to accept it. Until you accept your mistake, you cannot move forward. Accept your mistakes and you will automatically move forward in life. Study the concepts. No question of yours will be wrong. It can't come from outside. These concepts are made with a lot of effort. Today, look, I give you everything in a structured way. And I guarantee these concept notes. You might think I'm praising myself, but let me tell you, a lot of effort has gone into this. That's why I'm saying it, and I'm saying it for your benefit. I'm telling you, these concept notes required unparalleled research and effort in their making. Other chapters also demanded time notes for each took 2 to 3 months, often working 10 to 12 hours daily. This chapter's notes demanded significant time and extensive research because this chapter, those doing business valuation in the market often don't understand the proper structure. They just know how to do calculations without knowing the structure. So these notes I have given, I guarantee you won't find them anywhere. Not in the module, and no one else can provide them. They keep mixing things up, whether it's equity or firm value. The institute isn't doing anything wrong because it's our way of studying that is flawed. That's why we put the blame on the institute. It's not wrong everywhere, just in 1 or 2 places, which I will also point out so you can logically verify it yourself. Understood? So study with a structure. The notes are very important. Everything's crux is in them. There are also some faculties in the market who have entirely copied my notes. I mean, if I were to talk about my previous batch specifically for this chapter's subject, 2 faculties from that batch have copied the notes verbatim. I just won't name them. Similarly, students thought it's for their benefit, but they could at least say they are using my notes. This takes effort and time. You must also work hard. Expecting results without effort means students won't pass. It's the same thing. If you guys also work hard, you will also get results. Without hard work, relying on 2 or 3 shortcut questions will not actually help. Watching YouTube solutions and thinking you will pass, then studying is useless. Then if your paper is slightly different, you'll start calling it tough. If you want to see a tough paper, look at papers from 4 or 5 years ago. Pick up those papers and you'll see what past exams were like, because the level these days is nothing. Alright, let's move on. Let's come to this topic. Look inside the income or earning based models. The first one is the dividend growth model. The dividend growth model will give you the value. How will you calculate the value using this model? We consider income or earnings as the base. When investing in a company's equity shares, only one thing comes to mind for earnings: dividend. So I will base the valuation on future dividends. And remember, the dividend growth model was the same model from the security valuation chapter. It was in more detail there, with constant growth, variable growth, fixed growth for a period, then different fixed growth for life. We saw it in that way. So the same thing is here. It's the same formula we saw in security valuation, the exact same model. Dividend growth model. Dividends are received on equity shares, and that means the valuation here will give you the value of equity. We are using earnings as the base. If I buy equity shares, I receive dividends. So let's determine the value based on dividends because a company's dividend signifies equity value. Are we finding equity value? Here we use one assumption, security valuation studied it differently, hence more methods. Here the assumption to make is the constant growth. You will keep getting dividends with a fixed growth rate for life. You can apply the PV concept. The PV concept taught in basics of AFM and revised in security valuation will be fully applied here because its application was there as well. If you haven't studied PV in basics of AFM, then it's pointless. We won't go into the details of how this formula was derived here. If anyone has a doubt how the formula was derived, watch my PV lecture from the basics chapter, the first lecture of FM, then you will understand. So will we get dividends in the future? How should we apply PV with constant growth? It's first perpetual cash flow divided by discounting rate minus growth rate. The first perpetual cash flow will be the expected dividend at the end of the first year, which we call D1, divided by the discounting rate. As this is equity cash flow, the rate will also be for equity called KE. So what return do equity shareholders want? That required return is the KE that you calculate, and from the company's point of view, it is the cost of equity, as I have explained. Minus growth rate. If D1 is given, otherwise calculate D0. G is the growth rate, and you must use the growth rate after the merger or acquisition. Let me carefully explain what this means. You can look at the companies, for example, Reliance Limited. As of today, Reliance Limited is growing at 15% per annum. But I thought as soon as I make it mine, I have so much intelligence that even its existing owner doesn't have. Imagine I have that capability to think like that. So as soon as I make it mine, from the very next day, Reliance will start growing at 18% per annum. What is the current growth? 15% per annum. But once I buy it, it will grow at 18% per annum. So when you do the valuation, which growth rate will you take in this formula? What growth will you get after the merger? It's a simple matter. I am determining the value for the purpose of acquisition. So if I determine the value for acquisition purposes, the future cash flow will also be received after my acquisition or merger. Future dividends are post-merger, so we must use that growth rate. Since cash flow reflects this growth, we take the growth rate after merger or acquisition. So if the question gives two growth rates, remember you will use the one after the merger. The KE, that is cost of equity using CAPM, is the return an investor wants. You calculate it as RF plus beta of equity. This return the investor desires is the company's cost. That's first priority. Suppose the question does not give you KE nor the data for CAPM. Now what will you do? Is the question wrong? Your second priority, calculate the cost of equity another way. This second method, which you have also studied in the security valuation chapter, comes from the very formula I have written as the second priority. What is the formula? It is D1 by current market price times 100 plus G. Here G, the growth rate, will be the company's current growth rate. Pay close attention to this second priority. This means what's the company's cost on equity? That's the meaning of KE, meaning the money the company has taken from equity. So what is the cost on it? So the current market price of the company's share. If any investor invests in the share, they will do so at the current market price. Investors receive D1 as dividend annually. The investment is the current market price, so they receive D1. Thus it's D1 by current market price. For the company, the money coming in is the current market price, and what's going out is the dividend. This expense is D1 divided by current market price into 100, and D1 is calculated as D0 into plus the growth rate. We add this to calculate the company's cost. This cost must account for a fixed annual growth rate because the company provides dividends with that fixed annual growth rate based on our assumption. In this model we have, why are we using the current growth rate here and why not the post-merger one? We are calculating the current cost of equity, the current market price of the company's share. So how is that determined? Because the traders create demand and supply. So those people don't know this company is about to merge or has merged. No merger has happened yet, the process is still ongoing. Therefore, in their minds, they are only operating based on the existing 15% per annum growth rate. How would they know that someone is going to buy it who will increase the growth rate to 18% per annum? Only I know that. So they are only thinking of a 15% per annum growth rate. The market price is determined according to that. According to 18%, as soon as the merger is announced, you will see the market price change. Those are all the reasons, which we have discussed thoroughly in the security analysis. So for the purpose of calculating KE here, you will take the current growth rate, and for the valuation, take growth rate after the merger. The rest of the details and proof are shown in the lecture. So you don't have to go into that for revision. Now look, there's one more point here. This formula calculates equity value using equity holders' earnings as dividends. Then to find the firm's value, apply this equity value to the basic equation. There's no problem. This formula is special. In this formula, if you take D1 as per share, you will directly get the value of equity per share. And if in this formula you take the total D1, then you will get the total value of equity. It's a simple point you need to remember, because in the exam, whatever is asked, if it's per share, take dividend per share, and if total is asked, take the total dividend amount. The value of equity is total. This was your dividend growth model. So you've understood the dividend growth model. It was an earnings-based model. Then what is the flaw in this method that requires us to learn the next one? It has a significant flaw that you can identify yourself. Look, I am talking about buying a company. I'm talking about buying a company from someone else, about making that company my own, and when the company becomes mine. When that company becomes mine, tell me, will I focus on this petty dividend or will I focus on the entire earnings of that company? Think about it. I'm not some small-time trader or investor who only looks at dividends. That should have been done in security valuation when your purpose was normal investment. My purpose isn't normal investment, it's to make that company my own. Once you make the company your own, its entire earnings are yours. So I should have a right to the entire earnings of that company, not just the dividend, right? I will have control over all the earnings. I will have the right to all the earnings. Why are you calculating the value based on dividends? You must calculate value based on the entire earnings. This is why the very next method in our earnings based model is the earnings capitalization method. The earnings capitalization method. Capitalize the entire earnings, not the dividend. What does capitalization mean? It's finding the PV of a perpetual cash flow. D1 divided by KE minus G is called capitalizing, meaning you've capitalized your dividend. So similarly, don't just capitalize the dividend, capitalize the entire earnings. Owning the company gives me rights to all earnings, not just dividends, so I must capitalize its total earnings. If you capitalize the entire earnings, you will get the value. Until now, all methods we've seen gave us the value of equity. But this earnings capitalization method will directly give you the business value, which means the firm's value. The value from this method is called the value of business because the institute says so, and the question will also ask for the value of business. Even if earnings capitalization method isn't mentioned, the data will show you to apply this. The value derived from this method is also known by another name, the earning value of the company. It is also known as the earning value of the company. Why is that? Because here you calculate the company's value using its earnings as a base, which means we calculate the value using the company's earnings as the base. That's why the value that comes from this method is also called the earning value of the company. It is essentially the value of the business, the value of the firm. It is also called the earning value of the company. And suppose in the exam you are asked to calculate it. You'll say, what did my teacher even teach? Because he kept going on about the value of the firm and value of equity when the institute asked for the earning value of the company. They've asked for the exact same thing, so just check your notes carefully. Notes are very important. It's the same thing. If you solve questions directly, you'll get stuck and just memorize how to calculate the earning value for a specific question. You should understand everything through its linkage. Even if a new question comes, you will never get it wrong. And if you need to find the company's earning value, you find the business value using the earnings capitalization method, which the institute asks in a question, okay? When we revise the questions, I will show you that thing. Finding the value with this particular method is a 4-step process. The 4th step is useless, and we will get the value in 3 steps. Now, before I start teaching this new method, let me tell you one important thing. This method, the value that is derived from it, should in its essence actually be the value of equity. The value that comes from this method should actually be the value of equity, not the value of the firm, not the firm's value. The value derived from this method should be the value of equity. Our institute calls it the value of the business. This is completely wrong. Study it yourself and understand. It's a clearly visible mistake which I told you about with full proof during the lecture, and I'll quickly tell you about that mistake again. Alright, in the exam, what should we do? We have to consider it as the value of the business. You must treat it that way in the exam. Don't think that you'll write equity value because the institute is wrong and correct it. The institute has been doing the same thing for the past 20 to 30 years and will continue to do so. Some people give advice that the institute will do this now. A major change will come. Everything will reach a certain level. Don't ever expect that whatever the state of the institute was before. It's the same today and will remain so. They will never change. I guarantee you this today. Alright, so just study what is there. Don't get caught up with advice from others. That's the simple meaning. The result will come naturally with knowledge. So there is a mistake here and we will identify that mistake. But if asked in the exam, we will call it the value of the business. We will treat it as the value of the business. But in practical life, this method's value is the value of equity. Let's see how to find this value. In this method, we are talking about capitalizing the company's earnings. We are looking at the rights to the company's earnings. If I make a company like Reliance my own, what future earnings will I get? You simply calculate the PV of those future annual earnings to get today's value. Once you do the PV of earnings, what earnings or profit will you get in the future? Because the entire profit has to be the base, not just the dividend. You must make the entire profit your base. What future profit will you get from the company? The profit you receive in the future is what we call future maintainable profit. In this method, we call it future maintainable profit or FMP, and that's what we calculate first. So why is it called FMP? Listen to this. This method has a basic primary assumption that the profit you get in the future will be the same every year. It will be maintained every year and there will be no growth in it. It's the most primary assumption because every single method has some assumptions, and a method is prepared only when those assumptions have been applied to it. No method can be created without assumptions. So whoever proposed this method, their assumption was that there will be no future growth. The future profit will be maintained the same profit every year. This means it will be a perpetual cash flow. As you learn in AFM basics, the perpetual cash flow will be fixed, and if we divide it by the discounting rate, we will get the value. That's what we have to do. So first, let's find out the perpetual profit that we will get for a lifetime. That's why we call it future maintainable profit, a profit that will be maintained every year in the future. How will you calculate it? Seeing future profit means seeing the future. Is there a time machine to see the future? No, because no one has ever seen it and we cannot build one. So what should we do? Estimate the future. How is estimation done? By looking at past data. From the past data. This means we should take the company's recent past profit and based on that estimate the future by applying crucial adjustments. So I will take the company's recent past profit, but from which past period exactly? Will it be from last year or from last 5 years? 10 years, 15 years ago, which profit? Now tell me which profit will give a more accurate estimation of the future. The most recent one from the previous year that has just ended. That profit will give a much better estimation, won't it? So just take the profit before tax from the recent previous year that just ended, whose information will be given in the question. Did you get it? Why did we take profit before tax? Why not profit after tax? For now, take the profit before tax as we are also making other adjustments. We will make the final tax adjustment at the end. You've taken the profit before tax. Now we must adjust the recent year's profit. Let's see them. If this profit before tax includes extraordinary income, you must remove it. Listen to what happened. Profit before tax means we have taken all the income and subtracted all the expenses, except for tax. So does all income mean that our profit also included some extraordinary income? Extraordinary income is not part of ordinary business and typically won't happen again. It happens by chance. For example, you can say profit on the sale of fixed assets. Since we don't regularly sell fixed assets, any profit is extraordinary income because it won't happen again. Remove if included in profit. When calculating future profit and non-recurring income is included, shouldn't it be removed? And if any extraordinary loss is included, you have to reverse it by adding it back. A loss means profit decreased. To reverse an extraordinary loss, you add it back. For example, a loss on the sale of a fixed asset. This doesn't happen in ordinary course of business in future. So remove and reverse, then add it back. You will understand. Besides this, we made some normal adjustments. So now, there's one more point. Suppose as soon as I buy the company, I'm thinking that I'm smarter than the existing owner. Since I am smarter, I will launch new products. And launching new products will result in sales and costs. What profit do you foresee every year in the future from launching these new products? Consider that as well now. Add the profit from the launch of a new product and how will that be calculated? Take the sales and subtract the material cost, labor cost, fixed cost or other costs. You've got the profit from the launch of the new product. So this is your future profit, but it's a future profit in which we haven't yet made the tax adjustment. So subtract the tax at whatever the tax rate is. You'll get future maintainable profit. Understood? It's very easy. All information is given. In practical life, this estimation is very difficult. All will be given in exam. These are free marks if you've understood it logically and memorized it. Step 1 complete. Now in step 2, I've figured out the profit I'm going to get in perpetuity, and this is basically a perpetual cash flow. We need to find present value of this as we'll get it in the future for its PV. To find the PV of a cash flow, you can divide it by the discounting rate with no growth. So see, in this method, the discounting rate has been named as the capitalization rate. The method's developer called it the capitalization rate, and that's fine. So in step 2, we'll find this capitalization rate, which is the discounting rate. What is first priority given in the question? The given rate, for example, 10% or 20%. This profit of yours will be maintained and you'll receive this amount every year. But your discounting rate is 10%. What does this mean? What is my required return? What does finding the PV of future profit mean? It means removing that percentage of return so that I can find out today's value and know how much I can invest today. I already explained this logic in basics of AFM during the PV topic, so I'm not focusing much. I am giving you a direct reference from there. So revise that if anyone feels that this logic was not explained. This is a revision video as this topic is covered in the basics. So repeating what has been taught in the basics is pointless. So calculate the PV. This rate is fine, second priority. If the capitalization rate isn't given in the question, what will we do? Before reading the second priority, let me tell you what mistake the institute makes. Then we'll move to the second priority. Now look. Here we have taken the future maintainable profit. What is future maintainable profit? In every way, it is the company's PAT. So it's the company's PAT with future adjustments. We took the company's profit before tax. We made future adjustments and a tax adjustment and we got the FMP. We effectively took PAT and made future adjustments to it. That is the core. So PAT, profit after tax, for whom is it available? It is available for the equity. Subtract the preference dividend from PAT, and you know preference shares are uncommon. If present, it's different yet not in questions. Since there are no preference shares, the PAT is for equity shareholders. I am taking that profit. I will see what PAT this company will give me in the future. I am taking the future PAT. This is the future's PAT. I just made future adjustments to the previous PAT and nothing else. PAT means what available profit will this company generate for the equity shareholders. So these earnings that I am looking at, for whom are they available? For the equity shareholders. What profit will the equity shareholders get? Whose value does this method provide? Equities or the firm's? The value of the whole firm is derived when the company takes a profit that is available for both equity and debt. In this profit, the interest for the debt holders must have already been deducted because we started with PBT. So the debt holders have already been paid. What does the value of the firm mean? It means the value of both debt and equity, and I have explained this in the basics. What is the value of the firm? It's when you combine the value of both debt and equity. But the profit we are looking at is only available to the equity holders. The debt holders have already been paid everything. This profit is only for equity holders, so finding its PV must give the equity's value. It's completely logical, but our institute somehow misses this point. So great, what can be said about the institute, but let's leave it. Whatever it is. It should have been the equity's value, and to calculate its present value, we should have used the required return on equity, or KE. KE is the rate for equity holders, but our institute differs here. The institute considers this profit available for both equity and debt. In the institute's view, this FMP is available for both equity and debt, and if you calculate its PV, you will get the value of the firm. You will have to assume this. So if this profit is available for both, what should be used for PV? The cost of both KE. The cost of both is called WACC. So the first priority is the discounting rate given in the question. Second priority, company's cost of capital, WACC. If it is equity's cash flow, we take the equity's discounting rate, KE. If it's the company's cash flow, then the discounting rate is also the company's WACC. Remember why WACC was necessary in this chapter, as it will also be useful here. It can be understood in another way which I explained in detail. I'll quickly explain it again here in the revision video as well. The profit generated in the future. The WACC is the minimum required rate of return because the company raises money from equity or debt, investing it in the business. It earns a return. If money is raised from equity and debt, the company incurs a cost and it must earn at least enough from the business to pay that cost. We must earn at least enough business return to bear the cost of the capital we raised. This is the minimum required return. WACC, it's used to find the company's cash flow PV. You can also understand that the future profit will be available for both equity and debt as per the institute. It's available for both, understand. So if it's available for both, then from this profit we have to pay the debt and equity holders. Since future profit must cover that payment, the amount is removed by deducting a percentage at the WACC rate each year. What does finding PV mean? It removes the return at that rate, and if you remove debt and equity payments, what value will you get? The resulting value is the business's, and the institute deems this whole method incorrect. Equity's profit, its PV with KE, should yield equity value. But the institute wrongly considers it profit for debt and equity. We must follow this. Third step yields business value. Future maintainable profit has no growth. Divide by the capitalization discounting rate, then you have the business value. This fourth step is even more useless since the institute makes more mistakes here than anywhere else. The fourth step applies solely if the institute explicitly asks otherwise, it's skipped. The question asks for the company's per share earning value. The company's earning value derived from any method. Tell me per share, it means the institute wants to say this. Value of business. Adjust this with debt and cash in the basic equation and you will get the value of equity. Then you can divide that by the shares to get the equity value per share. It's not asking that, the great institute. Here it didn't say equity value per share. Here it says per share earning value of the company. Directly make the earning value per share. Make the earning value per share, which has no logic, no rhyme or reason, no sense at all. There is no interpretation for this, but if it asks, you will have to do that. Take the earning value of business that you calculated, take that as it is and divide it by number of shares. This has no interpretation. It's a question in the paper. You will do it and I will show it in the reference. The one we did in regular batch. So with this, the method is complete. The FMP1 earnings capitalization. Now let's move forward. We have explained the earnings capitalization method. Now, does this method have a flaw, prompting us to move to the next models? It does have a flaw. The flaw in this, we took the earnings. We took the company's total earnings and then capitalized them to find the value. The mistake here is what the institute is doing wrong, and that is the practical flaw of the method. The practical flaw in this method, and let's be clear, we are not discussing the institute's mistake, is this. Are you calculating the value based on the company's total earnings? But total earnings can include non-cash expenses like depreciation. That's the major one. Depreciation is not an actual expense, whereas the profit you took has depreciation already deducted. Focus on your company's cash profit on the cash flow. An expense that is not actually yours but arises just by passing an entry in the books. You shouldn't let the company's value deviate on that basis, as you would simply be reducing its true worth. So remove all non-cash expenditures and focus on the cash flow. How much cash flow is the company able to generate? Why so? Because there's a big reason. I can even tell you about companies in the market that show you a profit of 10 lakh rupees in their books. When you calculate their cash profit, it won't even be 10,000 rupees. They fool people like this. And you should understand that if there is such a company, then there is no bigger fraud company than that. All these small things are very useful for your investment decisions in practical life. But since they're not officially part of the syllabus, we cannot discuss all that in so much detail. My syllabus will exceed 500-600 hours, and that is different knowledge for practical life. But these are very small points. Convert it to cash flow, specifically convert the earnings to cash flow. Then calculate the value by doing so. And the next model is the cash flow based one. These cash flow based models are part of the income or earning based models in practical life. These are not separate models, but the institute treats them as if they are, and that's fine because it doesn't really matter as the calculation method is the same anyway. So the calculation here is all correct. It's just wrong in one place. It's part of the earning based model. Because in these models, you will use earnings as a base. And based on those earnings, you will convert them into cash flow. You will take the earnings and convert them into cash flow to calculate the value. What was the earning based model's flaw? Earnings taken included non-cash expenses, which must be adjusted to cash flow. Now consider the first method in the cash flow based model, free cash flow to firm. It is the most important. This is a very easy method. Nothing is simpler if studied conceptually. It is correct and the institute makes no mistake here, which I clarify first. So free cash flow to firm, FCFF method, you should know from the name itself. Free cash flow to firm. You have to find out. What does free cash flow mean? It means the cash flows that are freely available to the company. With all company expenses paid, cash flow now remains. The free cash flow the company generates, expenses. After generating earnings and removing all expenses, how much free cash flow remains? Cash flow that is freely available to be given to the capital, that is free cash flow to firms. You have to find the free cash flow available for the firm, free cash flow available for the entire firm, free cash flow available for the entire firm. For the firm, meaning for both equity and debt, I have already told you. The value of equity and debt is called the value of the firm. Meaning cash flow for the entire firm implies two parties, equity and debt. What's the cash flow for both parties? This means find a cash flow from which we can make payments to equity and debt holders. We haven't paid them yet. We haven't paid the equity and debt holders yet. We are going to make payments to them from this cash flow. Find that cash flow. This can also be understood in another way. Find a cash flow where you assume that both equity and debt are effectively the owners of the company. So always remember about the owner. The payment made to the owner is not made from the P&L. They are paid out of appropriation. There is a P&L appropriation. You do it like this for equity holders, right? Free cash flow to firm, find cash flow available for both equity and debt. This method considers both equity and debt as owners. So this method will give you the value of the firm. This method is correct for the value of firm. The institute is not wrong here. This method gives the value of firm as you calculate the cash flow for entire firm. You will calculate the entire cash flow that the company makes available for the whole firm. How much available cash flow the company can generate for the entire firm, you will find that and calculate the value based on it. The first step in this is to find the free cash flow to firm, which is very easy. It's written right in front of you. If you understand the logic, you won't face any difficulty. We have to find the free cash flow to firm, FCFF, which means such cash flows that should be available for the entire company for both debt and equity holders. The cash flow available for both debt and equity holders, we have to start with earnings and convert earnings into cash flow. So which earnings would be available for both debt and equity? The earning before interest and tax, EBIT. It's earnings where interest and tax haven't been deducted yet. Don't deduct the interest payment, which means this is a profit from which interest is yet to be paid, and equity holders are paid later anyway. We have considered both as owners, and as owners their payment is not yet deducted from the profit. Just take EBIT. Understood? This is a profit from which both equity and debt have to be paid. That is, I have taken the earnings available for equity and debt. That's all. It's as simple as that. And from this deduct the tax on EBIT, because tax has to be paid anyway. You need to remove the tax since it doesn't belong to equity or debt, it belongs to the government. So you must deduct tax from EBIT, and remember the tax will be a percentage of EBIT. It's not that you are deducting the actual tax amount on PBT, don't do that. Here we'll deduct tax directly from EBIT. Regarding the tax percentage on EBIT, assume no interest or debt in the company. Then EBIT is PBT and the tax rate is applied to it. So deduct the tax using the EBIT tax rate, and what will you get? Net operating profit after tax. You also call this NOPAT. Look at this warning carefully. Remember, NOPAT will be very useful now. Why is this called NOPAT? Just like when you deduct tax from profit before tax, you call it profit after tax. We call EBIT operating profit. To understand how, refer to the basics of AFM. I had made an income statement listing their synonyms and what they are called. So you avoid confusion if anything is written in the exam. This was for that purpose. So EBIT is also called operating profit. So in this, if we deduct tax from it, what will you call it? Operating profit after tax. So we call it net operating profit after tax. Understood? So we didn't do anything. We just in a way would take PAT. Instead of that, we took EBIT because we need a profit that is available for both equity and debt, and EBIT minus tax is what gives us NOPAT. We now have NOPAT, which is the profit available for equity and debt, but since this is pure profit, we need the cash flow. We must add non-cash expenses. So see how you will do it. We have to add the non-cash expenses, that is generally your depreciation. This is a profit where you have taken all the earnings and deducted all the expenses except interest. Apart from interest, you have deducted all expenses. Depreciation must have been deducted, but that's non-cash and no actual cash outflow occurred, added back. Is depreciation the only non-cash adjustment? Other non-cash items exist, but it's generally just depreciation, and in exams you'll only find depreciation. You won't find any other non-cash item in the exam questions for this method. If you find one, then adjust for that as well. But making a long list is pointless, since the most important thing is to know the logic. So we added depreciation. Apart from this, what other adjustments will you make? Listen carefully now. We need to calculate the cash flows, which means what the company's cash flows will be. For the future, what cash flows will Reliance Limited generate every year? For this, let me tell you, when we are talking about a big company, they also have to make capital expenditures every year in the future. The big companies, if they want to grow their business every year, what they do on machinery? They spend on PPE, which we call capital expenditure or CapEx. And they will have this capital expenditure every single year. Annual capital expenditure reduces funds, and this will be deducted. We have to calculate the cash flow, so that will also be deducted. Now the institute shows this in a more direct way, because they simply present it as net CapEx. It deducts it as net CapEx, saying CapEx minus depreciation. It directly nets the amount of CapEx minus depreciation and deducts it. Consider an example. Depreciation added, assume 80 rupees. And the CapEx for the future is deducted, and let's assume it's 100 rupees every year. Deduct 100 rupees cash outflow. So what is the net effect of these two? Plus 80 and minus 100. I explained this in basic mathematics. You will get minus 20 from this. I taught this in basic mathematics, even if you haven't studied math in school. I taught this as well. So it's minus 20. So you can also do it like 100 of capex minus 80 of depreciation is net capex. Net capex of 20, what is net capex? It is less, so deduct 20. The institute also shows it by netting it. You should know, we do it in some questions and it's necessary, so we have to do it. Remember this net capex. Perhaps you wonder if there's logic. Indeed, a proper logic exists, which you should have known from studying accounting in 11th class, but since we don't know it, I will explain it. Look, when a machine is installed in your business, it undergoes wear and tear, and as it gets old, you then record depreciation for it in your books. You record that depreciation because you know that in the future this machine is getting old, you'll need a new machine, you will have to do more capex. So you start accumulating money in the name of depreciation in a way. So it means I accumulated 80 rupees this year in the name of depreciation. How much was spent on a new machine? It was 100 rupees. How much extra did I have to pay from my pocket? 20 rupees. Did you get it? This is the logic. So what you'll do is deduct net capex from NOPAT, which is capital expenditure minus depreciation. You can also do plus depreciation minus capital expenditure if you want, but in some questions we will have to do it the net way. I will also show you that question and why we have to do it. We will revise the questions point now. After this, another adjustment follows, then you get FCFF. What is it? Plus or minus changes in working capital. And what is this? If there is an increase in working capital, then deduct. If working capital decreases, then add it because we know this. If working capital increases, we will deduct it. The cash flow will decrease, and if working capital is falling every year, we will add it back because that's a cash inflow. Why is this happening? Understand, there's investment in working capital. When working capital increases, the business invests money in working capital. So it's a cash outflow, deduct the money. Working capital is falling, which means we are taking money out, creating an inflow, so add it. Understood? Understand working capital, current assets minus current liabilities. I'll assume a company that only has debtors and no other current assets, current liabilities. So the debtor itself becomes the working capital. So think, if I increase my debtors, my working capital has increased, meaning money is now tied up in debtors. My money is stuck, isn't it? My money is stuck in that debtor because I had to collect money from that debtor. The debtor has increased, which means money is stuck, which means cash outflow. That is deduction. If debtors decrease, working capital has decreased. Cash comes from them, resulting in cash inflow. Working capital is decreasing. Apart from this, it's most important, I have told you the logic, this whole thing. I also explain it logically with an example which you might be studying the cash flow statement probably since 12th class. Because at that particular time we used to study cash flow statement at high school level. And the logic for working capital adjustments is explained at that time. Just as in cash flow statements, we converted profit to cash flow. And the working capital adjustment, it came from here. The logic behind it is the same that will apply here. That was the logic, we were never taught about that, so that's their fault. I'll quickly explain it once. Then the logic of the cash flow statement at the final level will become clear. Look carefully. After this, you'll never forget the working capital adjustment logic and will know exactly why it's done. For a moment, I am assuming working capital has only debtors and I am taking a small example to explain its logic, not a detailed one. The company's working capital has only a debtor and suppose its opening balance is 100. Closing balance is 115. Use a ledger account to understand. During the year we sold to the debtor. Debtor to sales 20 rupees. Any problem? The account has a 5 rupee difference as a balancing figure on the credit side. Record it as buy bank or cash. Assuming cash came and we prepared ledger account similarly in the cash flow statement. Now see what this means, the interpretation. See, during the year I made a sale of 20 rupees to the debtor. And out of which during the year I received 5 rupees from this debtor. So I can say that out of the total 20 rupees sale I made to the debtor, 5 rupees was a cash sale and then the remaining 15 rupees was a credit sale, a sale made on credit. That's the point, 5 rupees cash sale, 15 rupees credit sale. But here when you see, we took the EBIT in the cash flow. In EBIT we have taken all the earnings, which mean all sales. We wouldn't split the sale between cash and credit as we have taken the entire 20 rupees. But if the total sale is 20 rupees and 5 rupees was a cash sale, then 15 rupees is the credit amount. 15 rupees is a sale that is a credit sale. A credit sale of 15 rupees, so this is the sale for which no money has been received. But it is part of my earnings and I need the cash flow. So should I deduct these 15 rupees from this or not? I have to deduct 15 rupees from this. 15 rupees should be deducted, understood the logic. So we apply the logic in a different way. Let's assume working capital only includes debtors with an opening balance of 100. Closing balance is 115. The working capital is increasing from 100 to 115, an increase of 15 rupees, and as I've told you, this amount must be deducted. Got it? This 15 rupees is being deducted for that credit sale. I have explained it completely logically, and if you still don't understand, then no one can help you. Similarly, if working capital includes creditors, credit purchases are adjusted. I've explained the working capital adjustment logic. An increase means deduction and a decrease means addition. This gives you the FCFF. This is the company's free cash flow to firm, and it's quite simple. You should logically know these calculations. We have FCFF. Second step is straightforward. Third, we will find out how much free cash flow to firm the company will have in the future, which is the cash it can generate for debt and equity each year. Now to find the value, the free cash flow is for the firm. So you will find their PV because they are for the future. So the value you get will also be for time zero. So the value will also be for the firm. And because the cash flow is for the firm, the value will also be for the firm. You can calculate the value of the firm by discounting the free cash flow to firm. Discounting cash flow to firm means finding PV. Using the cost of capital of the company WACCKO, when the cash flow is for the company, that is for the entire firm. Then the discounting rate should also be for the entire firm, which means you take the discounting rate for both the company's equity and debt holders. The cash flow is such that both equity and debt have to be paid out of it. Since this cash flow is for both, the discounting rate should be for both. I've always said a fixed concept in FM is the discounting rate must match the cash flow, and its logic has been explained many times. I will explain it to you here as well. FCFF defines the total future cash flows from which payments to equity and debt still have to be made, because we haven't done that yet. We have calculated those future cash flows from which payments to equity and debt still need to be made. You will find the PV using WACC, and finding the PV with WACC simply means removing the payment for equity and debt from future cash flows. You have to remove the payment for equity and debt, and yes, removing this payment is what we are doing. So you will get a net value of what the firm should be, right? Understood? Now to calculate the PV. If it's in perpetuity, this is just basics of AFM, nothing new. For perpetual FCFF with constant growth, you'll receive it at a fixed rate forever. Perpetual cash flow by discounting rate minus growth rate. FCFF1 divided by KO minus G. How is FCFF1 at the end of first year? FCFF01 plus G. If you have a perpetual FCFF with variable growth, that is, you will get one growth for a limited time. After that, it will continue for life with a fixed growth. You will get one growth for 5 years. From the 6th year onwards. From the 6th year onwards, it will grow at a fixed rate for life. So for the first 5 years, which is a certain period, take it as uneven FCFF. Uneven means different FCFF in the table. Put KO in the table and find the PV using the PV factor of KO from the PV table. There is a two-stage order here. Starting from the 6th year onwards. The FCFF that you will get for life with a fixed growth rate. 6th year's perpetual cash flow divided by discounting rate minus growth rate. If you find PV, get the value at 5th year end. The value is obtained at the 5th year end, and for perpetual cash flow, PV yields the value 1 year prior. This perpetual cash flow yields 5th year end value, which you also call the terminal value. Because think about it, if I have to find the value of the firm at the end of the 5th year, looking at future cash flows and by finding their PV from the 5th year onwards, you will get the value at the end of the 5th year. You can terminate or sell the company at this value. Firm value at 5th year end. This firm's value at the 5th year end is called the terminal value. Bring this to time zero for today's value using terminal PV. So for perpetual FCFF, finding the PV of the terminal value will give you the value of the firm. I will verify with the question, but this was in AFM basics. We have done this with our example. Its application reappears here for security valuation. So this method is complete. I will now give you extra knowledge on this method, not needed for the exam. But people want knowledge, so I'm telling you for that. The confusions they have, regardless of the question solution, using our extra brain is important. So the most important thing. Some of you might be thinking when we are calculating FCFF, we are adding depreciation to no PAT. It couldn't be more better. Why not use earnings before depreciation, interest and tax instead of EBIT? You get tax savings on depreciation as it's an allowed expense in income tax, and that is why we first remove depreciation to take the tax saving on it. And after that we add back depreciation. Understood? So rather deducting interest, it is also allowed in income tax. You get tax savings on that too. What about that? But the interest tax saving is accounted for differently. How? To find the PV of future cash flows, you use WACC. In WACC, there is KD, which is the post-tax. You give the interest rate as 1 minus tax. You already consider the tax saving in it. Understood? So you should already consider that. Everything is logical, nothing different. So with this, your FCFF method is complete. Now let's move to next method. Cash flow model, free cash flow to equity is FCFE. This method is like the FCFF method, and if you have understood that, you will face no problem. Now understand this point. See, this method was given by a different person. Keep this clarity in your mind first. Look, there was an individual who wanted to find the value of the firm based on cash flow. This was on his mind day and night. He developed the free cash flow to firm method. We saw it completely logically, there was no problem. Similarly, there another person was also working on a method in parallel. He focused on finding a direct method to calculate equity's value using a cash flow model. This was on his mind day and night, leading to the free cash flow to equity method, FCFE method. In this method, you find the free cash flow the firm makes available for its equity holders. So you need to find out the cash flow the company generates for its equity holders. This method gives the value of equity, and the first of two steps is to calculate the free cash flow to equity. The logic will remain the same. We will just do some extra things in this which we will understand. First, free cash flow to equity. So first of all, find the earnings available for the equity holders, PAT, profit after tax. Isn't preference dividend deducted from this? It won't be in the question. It's absent from questions and exams. Preference isn't there. If by mistake it does come, you should remove it. If no preference shares, PAT is the earnings available to equity shareholders, so we take PAT. Alright, we took PAT. What did we do? PBT minus tax PAT. Why we do EBIT minus tax for no PAT? We took the firm's earnings. Here we took equity earnings, so that's the only difference. Then it's the adjustments. I won't explain the logic again. It's net capex, deduct capex minus depreciation. Then adjust for the plus minus in working capital, add a decrease and deduct an increase to get FCFE because the logic is the same. There is one extra adjustment, keep that in mind. When you adjust for net capex and decrease increase in working capital, you have to multiply it by 1 minus the debt ratio and then adjust. Look at the net capex. I have multiplied it by 1 minus the debt ratio, and I have also multiplied the change in working capital by that same ratio. If you don't do this, the entire solution will be wrong, and most of the students don't do this. It's written all over, yet they don't do it, and many of them lack the logic and cannot do. They don't understand this, thinking it's useless to even bother. It's not useless, it's logical. Understand what we are doing. Logic behind this. First, look, we took the PAT for the equities earning. We'll do the same adjustments. The only difference is that in these adjustments, we have also multiplied by 1 minus the debt ratio. Understand the reason we are doing this. What is the equity ratio? In basics of AFM, equity ratio is 1 minus the debt ratio. What is the debt ratio? I have already given you its formula. Debt divided by debt plus equity. The total capital that a company has raised is from debt and equity. The debt ratio tells you how much of that money has been raised from debt. The company issued 30 rupees in debt. And let's say, for example, like in a balance sheet situation, it raised 70 from equity, 30 from debt, total 100 rupees. So 30 rupees from debt, divided by debt plus equity, 70 plus 30, which is 100. Thus 30% of the total capital has been raised from debt. Equity ratio is equity divided by equity plus debt. This means 70% of total capital came from equity. The debt ratio shows how much money has been raised from debt in the total capital. If 30% of the total capital is raised from debt, subtracting 30% from 1, like 1 minus 0.30, writing 30% in decimals gives you this, resulting in 0.70, the 70% equity ratio. You shouldn't have any problem with this. The equity ratio shows 70% of capital came from equity, and you know this. This means when you multiply this adjustment by 1 minus the debt ratio, you are actually multiplying it by the equity ratio. What is the equity ratio and why are we doing this? The reason is, let's say there's a company. I raised rupees 70 from equity and rupees 30 from debt, so I got rupees 100. These 100 rupees, for business operations, a company raises money from equity and debt, and this money is then invested. This money is invested in the business. Now see, when a company raises and invests money in its business, it means spending on capex. Or this is about putting money into working capital. This money is invested in the business for capex and working capital. Let's take an example. These 100 rupees that I raised, I spent all of it on capex, meaning I bought a machine for rupees 100. Entire amount was spent there. So think, the machine I bought for rupees 100, where did the money for it come from? 100 rupees came, 70 from equity and 30 rupees from debt. This means to buy this machine, equity holders gave rupees 70 and the debt holders gave rupees 30. Both parties provide the money, and that money is then invested in capex and working capital. Is this point clear to all of you? So listen to me. For whom are we calculating the available cash flow? How much cash flow will be available for equity holders? Cash flow available to equity holders means paying off everyone else besides equity. Consider only equity as the owner, and that's why we took profit after tax, having paid everything like interest on debt. Equity is the owner, their payment is not made. You should understand this. We took their profit. Whose profit? Only the equity holders. We've already paid debt holders. This profit is available only for equity. Out of this profit, we have to spend on capex and working capital. Let's assume this. So this profit was available for the equity holders when you have to buy a machine through capex. What will equity holders say? The machine is 100 rupees and you want to deduct all of it from their share. We have contributed 70% of the capital in business with 30% from debt. Our contribution from the equity holders is 70%. For a 100 rupee machine, equity contributes 70 rupees, it's 70% share. Ask the debt holders for the other 30%. Our contribution should only be 70%. So if you're looking at our profit, why should we bear the debt holders' share from it? We are not fools. Debt holders' share should come from their own profit. Therefore, the equity holders will only bear their own share. Let me give you a general example from the regular lecture to help you recall it. Let's assume you are 3 siblings and your parents gave all 3 of you 500 rupees each and encouraged you to go and have some fun. You went out to a party. You had a pretty good dinner at the restaurant. And the dinner bill came to 300 rupees, as we can assume you don't eat a lot. Now this dinner bill of rupees 300. Tell me who will pay for it. Sir, all 3 siblings should pay 100 rupees each. Their parents gave each of them 500 rupees. All 3 should contribute rupees 100 each for that dinner. But one of the children, one of the sons was a bit too kind. He said, deduct the entire rupees 300 from my rupees 500. So that means 2 of them were more clever and he was a fool. Is it like that? Those 2 had a good time on his money and they ate for free. He paid for everyone from his share. That means he should have contributed rupees 100 but paid rupees 300, and similarly, this profit is available for equity holders since debt holders have been paid. So if we have to spend on a machine, on capex, on working capital, then debt and equity will contribute in their respective ratios, right? So from my profit, I will only contribute my share, the equity's contribution, which means I will multiply by the equity ratio. We also call the equity ratio 1 minus the debt ratio. Just apply that. Have you got the point? This was the thing, the one extra adjustment I had to explain. I've done that. I've explained it completely with logic. You will get the FCFE. Once you have the FCFE, finding its PV gives the value of equity because this cash flow is for equity. For PV, use the cost of equity as the cash flow is for equity. For constant growth FCFE PV, it's FCFE1 divided by KE minus G. For perpetual FCFE with variable growth, calculate the PV of uneven FCFE using a table. And the perpetual FCFE will have a fixed growth rate. For its PV, divide the first perpetual cash flow by the discounting rate growth rate. It arrives just before the perpetual period called terminal value. Discounting that terminal value to time 0 gives its PV. If you total this up, you'll get the value of equity, and the FCFE model is also complete. Both FCFF and FCFE models have been explained. Here are some key points. Some students might have a query. I calculated the firm's value using the FCFF model. I'll use the basic equation and adjust for debt and cash to find the value of equity. But FCFE model gives equity value. Or I calculated the value of firm from FCFF, then calculated value of equity from FCFE, and adjusted using the basic equation to derive the value of firm. Will these two values be the same? The equity value from FCFF and FCFE, FCF's firm value and FCFE's equity value. Will both methods yield identical value as they appear similar? They will not be identical, the match could be coincidental. I've already told you every method will give a different value. The basis of both methods is different. 2 different people gave the methods, both are conceptual. But their logic and assumptions differ completely. Here we started with NOPAT, not deducting interest and other items. And then the adjustments for capex and working capital were also fully accounted for. The discounting rate would be WACC. Here you are removing interest, after that you adjust with 1 minus the debt ratio. What else are you using? The value cannot be the same. If it's coincidentally the same, that's different. All methods will give different values. Always remember that. Many people don't know this, I'm telling you. When I used to study at my time, it was my habit. Because let me tell you, I did it all by myself. I've told you this before. The final studies for CA final, me and my brother Atul, we both did self-study. We took classes up to the inter level. At final level, our finances were not good. The fees charged and the teachers we had then were not good. We knew their nonsense teaching wasted time and only made us fail. We used to say those teachers would make you fail, they are only making money. Anyone thinking carefully would grasp what was truly happening. And on top of that, our financial background was not just bad, it was non-existent. Today it's very good. All thanks to your blessings, your support and God's grace, because everything is due to that. So at that time it used to come to my mind when I studied FR, SFM, I was the one who prepared them. and my brother would prepare the other subjects. So we would make notes accordingly and exchange them to study together. So today I'm teaching the same subjects. When making these notes, I looked at the logic behind them. So this involved a lot of research. I used to think that the value of equity from FCFF and the value of equity from FCFE should be the same. Back then I didn't know anything. The exams were over when I started teaching. Then I did more research, and now I have the opportunity to tell you that no, the value from this will be different after complete research. There are many such things that come to someone's mind. That's why I explained that this also happens. For those curious to know, for the exam, everything is written in the notes. Now I will tell you a few more things. We have a note here common for FCFE and FCFF cash flow methods. If there is no debt, if a company has no debt, let me tell you, PAT and no PAT become the same. If PAT and no PAT are the same, then FCFE and FCFF will also be the same. So let's look carefully at how. If a company has no debt, then you will see that its EBIT and PBT will be exactly the same. There is no interest expense, so the interest expense in this will be zero anyway. If EBIT and PBT are the same, then the resulting tax will also be the same, making PAT and no PAT equivalent. Adjustments for capex and working capital. With no debt, a 1 minus debt ratio adjustment cannot be made. In such a question, FCFF and FCFE become the same. So let me tell you, if a question tells you, or if there is a company in practical life that has no debt, if the question lacks debt information, in such questions, consider PAT as no PAT. Consider FCFF as FCFE. The institute isn't wrong, you just need to use your brain. After this, I'll give you a reference and will revise during the question. There will be a question in which PAT is given. Now in the question, you will need FCFF and to find the value of the firm. PAT is given, how to find the value of the firm. The question is not wrong because with no debt, PAT becomes no PAT. No debt means PAT is only no PAT. FCFF is FCFE. Everything is equal. The value of the firm that comes will be the value of equity. Remember this point. This was written so that if it comes in a question, you don't declare the question wrong. You identify it yourself, use your brain, you could be wrong somewhere. So sometimes learn to accept that we can also be wrong somewhere instead of blaming the other person. Now look at the second important note in this. I had said this chapter's purpose is merger and acquisition, and another is strategic decision making. In strategic decision making, a company adopts a new strategy, such as selling the product this way. We will apply this marketing strategy, this production strategy, this distribution strategy. A company applies a new strategy so that it can grow its business. Companies apply new strategies for business growth. So the decision of whether the company should implement a new strategy or not. How will we make that decision? What benefit will the company get from the new strategy? What will be the value of the business with the new strategy? Find that out. You have to find the incremental value from adopting a new strategy. What will be the company's incremental value from a new strategy and the extra benefit? Meaning if the company does not follow a new strategy, it will continue with its existing strategy. If it continues with the existing strategy, the company will still have some value, right? So determine the value of existing versus new strategies. This difference becomes the incremental value from strategy adoption. A question on this comes and I will show you. You must calculate the firm's entire business value after adopting the new strategy. How to calculate it? Using the FCFF method, given future cash flows for the new strategy, PV them. I have explained. Subtract the existing firm value before the strategy, which is its value if the new strategy is not implemented. How to calculate it? Use existing NOPAT divided by KO. Existing profit divided by KO. The firm's existing value is then explained. I'll explain the logic for a question that students call wrong, believing the institute made a mistake. However, the question is correct, our unclear concept leads us to declare it wrong. And special things happen, especially with teachers. Those who just solve what the institute is doing in the question on YouTube, we think what a great teacher he is, while he himself doesn't know what the institute is doing. No one explains the logic or the reason why they do it. And we're happy because our questions get solved for free. For free things, you're only fooling yourselves. Everything has a cost, you need to understand where cost applies. Now look here. The firm's existing value before strategy is existing NOPAT divided by KO. Understood? Calculate the value of the firm before the strategy. What will be the value if you don't apply the new strategy? So the first point that should come to mind is, why does the company want to apply a new strategy? A company wants to apply a new strategy because it wants to grow. Any person who wants to grow applies a new strategy. If you don't follow a new strategy, you can never grow. You will continue at the same level. Your level will remain exactly the same. If you don't apply a new strategy, whatever your current earnings and current cash flows are, they will remain the same in the future. Always remember this. Existing strategy means there is no growth in the company. You should know this point. We follow a new strategy precisely so that the company can grow. Think about it logically for a moment. The purpose of implementing a new strategy would be for the company to grow. So the existing strategy running in the company will have no growth. The existing strategy has no growth. This means the existing cash flows will continue in the future. The existing cash flows will continue in the future. So now pay attention. I have to calculate the existing value of the firm, which means making the existing cash flows continue. To find the firm's value from these continuing cash flows, you will need to use NOPAT. We start with NOPAT to calculate FCFF. So you take the existing NOPAT. Use the existing NOPAT. Fine, no problem. We have the existing NOPAT and adjustments are still needed. Of net capex, meaning add depreciation less capex, and plus or minus decrease or increase in working capital. If we don't see any growth in our firm, do you know what the logical consequence is? If no growth is visible, then our firm, if there's no growth, value isn't declining, which we also assume. Existing value means that we will just continue the firm's value as it is. There will be no growth in it, so there will be no decline either. So if you don't want your firm's value to fall, what do you have to do? Every year the company, what did I say? We apply depreciation on old machines because they are getting old, there's wear and tear. You will need new machines because if that old machine breaks down completely one day, the entire business will shut down. Understood? So we apply depreciation so that you can spend that accumulated amount on new machines. Therefore, in a no growth scenario for the company, you will spend only as much money on capex as the amount of your depreciation. You spend only as much money on capex as your accumulated depreciation. Meaning capex minus depreciation, the net capex becomes zero in such a case. Because if, let's say, in such a case, you are not going to spend even ₹1 on capex. In such a case, your value won't increase, right? But the value will also start to fall because the old machine will eventually stop working completely. This would mean no earnings, no cash flow, and no production. Understood? In the case of an existing strategy, there is no growth. You won't spend extra on capex, but in this case, you will spend as much on capex as the amount of depreciation. So always remember, when there is a no growth case, the amount of capex minus depreciation will be zero. That's why in such a case, we say net capex is zero. If net capex is zero and you adjust it in the existing NOPAT, it makes no difference. Understood? When a company doesn't need to grow, why adjust working capital? Maintain it at the same level. That is zero existing NOPAT becomes the free cash flow. With no growth, existing NOPAT becomes perpetual free cash flow. Divide this by KO to get the firm's existing value. Got it? Now you understand the value. How to calculate the existing value of the firm. We have a question where you all consider it wrong, which is absolutely correct, but since our logic is not clear, we consider it wrong. Working capital also has logic. When you don't want to grow the working capital, you naturally don't invest in it. This is quite logical. Today, let's say if I want to grow my business, what do? I go to the market and I place my product in numerous shops and I say, keep the product in your shop and you can just pay me for it later on. Meaning I increased my debtors. I increased my working capital, allowing later payment. I do this with those people. To grow my business, I leave products for free, collecting payment later. They agree as immediate payment is not required. So my business will grow because if the product is in the shop, some customer will come and buy it from them. But if I don't want growth in my business, I won't go through this hassle. I will say, let the number of debtors be as they are. There is no need to leave products for free and I will collect the money from the debtors on time. I have taken a fixed stance. I do not seek business expansion and I am content. Understood the point? Only if you want to change the business to increase or decrease growth, then you change the working capital. Otherwise, you make no changes to the capital, just remain the same. Clear? So I have cleared this point for you as well. With this, your cash flow based model is also complete. This was your most important model. This is the most important model widely used in practical life and also essential for the exam. Are there flaws in the cash flow based model? Every method had them and this one too. This method is logical. Logically, it is correct in every way. But there is no accuracy in any method, which is why this method also won't be able to give you a completely accurate value. Why, sir? Why won't this method provide an accurate value? What do you think? This method requires significant estimations in practical life regarding future cash flow, capital expenditure, and working capital changes, which is not easy. I said ask those who do valuation work in practical life. It's a very complex task. Many judgments are involved and it takes time, but in exams all the data is given and you just have to input it for the answer. Practical valuation is an estimation game. Proper estimations aren't guaranteed, so the value's accuracy can't be ensured. This is the method's flaw. There is no accuracy in any method. So sir, accuracy won't be in any method. I said it won't be in any of them. So all models are complete. Just one last model is left, the relative valuation model. Now see what this is. Look here. I have taught all valuation methods. Now the relative valuation models. These are a different kind of model. Let me tell you their main use. The models I have told you about so far are generally used in the market. But this relative valuation model is a different kind. Listen, its meaning is evident in its name, relative valuation. You will then find out the relative value. This relative value means you find a company in a similar business and a similar industry. I will find a similar company in the same business I am in and take a ratio or multiple of that similar company. I will take it and apply it to my company's data, and from that I will calculate my company's value. This means I am using relative data, taking a ratio or multiple of a similar company and applying it to my company's data. We call that relative value. So sir, how is this value accurate? We wanted an accurate value, but this isn't calculated for accuracy. This value is for support. What happens in practice? Listen carefully. A company calculates its value using other methods, for example, the FCFF method. FCFE calculated equity value 300 per share. Value calculated in practice for any company. Using relative valuation, equity value per share was 290 after applying a similar company's ratio to my company's data. Equity value at 290. This means this relative value of 290 is to support this value, to confirm it, to cross-verify it. Our model gave 300, relative value 290. This means it's somewhat accurate. The 300 value is fine. But if our FCFE value came to 300, look here. The relative value we calculated, if that was 200, this value doesn't align. The significant difference indicates an estimation mistake in this valuation or FCFE. Getting it? Or you should provide a justification. Maybe something like you are expecting a sudden jump in growth in the future, that the company will grow significantly, or it will do major cost cutting. That could be a different scenario. If that's the case, you should explain it. So this gives us a kind of confidence that the value we have calculated is roughly the same as the supporting relative value, which means our accuracy is fine. We use it for that. For the exam, you simply calculate the value using the specified relative method. Okay? In relative valuation, you will now study 4 methods which are very easy. It won't even take 5 minutes. Look, let me tell you one more thing. In practical life, many times the methods of relative valuation are treated as normal methods. In practical life, companies calculate value using multiple methods and average them. Often in practical life, companies do this. One method calculates value from dividends, another from FCFE. Values are obtained from market price and relative valuation methods, and they will average these 4 and use it. The relative valuation model is often treated as a normal model and frequently appears in practical life, so feel free to use it when available. But its main purpose I have already told you. Next, the first relative valuation method, the sales or revenue multiple method. Sales and revenue have the same meaning, you should know this. So the sales multiple method. This means you take the sales multiple of a similar company and apply it to your company's sales, and you will get the value of your company's firm. You will get the value of your firm. The fundamental of relative valuation remains constant and its logic is consistent. You pick up the ratio of a similar company, apply it to your company's data, and you will get the value. A ratio is also called a multiple. They are also called multiples. Look what happens in this. See, suppose I have Jio, my company is Jio, and I want to find its value using relative valuation. So first I need to find a similar company. I found a similar company in the market, Airtel, which is in the same telecommunication business, has the same kind of business model, similar costs, everything is similar. Their business model is very similar. So I found out Airtel's sales multiple. A sales multiple is essentially a sales ratio. Which kind of ratio? Enterprise value is firm's value now divided by sales. When we talk about a sales multiple in this model, we call it enterprise value. Otherwise, it is the value of. Sales multiple means enterprise value by sales. Do you know what this means? How many times of Airtel's total sales is its firm's enterprise value? How many times the sales is the enterprise value or the firm's value? Sales belong to the whole company regardless of funds raised through equity or debt. How many times of sales represent the company's value? It is a commonly used market factor. So sir, here a multiple of anything can be taken, of expenses of anything. Of course, you can take it for anything, but I can't just keep making a list. How long would the list be? We will discuss the multiples in our syllabus, and these are also the most famous in the market. We will discuss 2 multiples, the sales multiple and one more. Okay, pay attention. So the sales multiple is the most used in the market. Find Airtel's sales multiple. Let's say Airtel's value of firm is available at rupees 5 lakh. It was valued at some point and its sales were rupees 1 lakh. What's the value of firm? Its value of firm was 5 times its sales. Okay. Sir, this means Airtel is in a similar business to mine. Everything is similar. If it can generate a firm value that is 5 times its sales, then whatever my sales are, my firm's value should also be 5 times that, because our businesses are the same. That's the logic behind it. What is my enterprise value? It's the same formula. To find the enterprise value from this formula mathematically, you have to simply multiply sales with the sales multiple. How to get the enterprise value? Sales multiple times sales. Now if Jio has to find its value, then how will the company calculate its own enterprise value? Take the sales multiple from a similar company. It must use its own data, specifically its sales data. Otherwise, if you take Airtel's data, you'll get Airtel's value. As discussed, suppose my sales are rupees 1,50,000. My enterprise value comes out to be 7,50,000. This is complete now. The sales multiple relative valuation is complete and simple. How will we get enterprise value? Take the sales multiple from a similar company, I have written in red, and multiply it with sales. After this, the EBITDA multiple method is the most famous one in this category. In this, take the EBITDA multiple of a similar company, apply it to your EBITDA, and you will get your enterprise value, the value of the firm. What is the EBITDA multiple? Enterprise value divided by EBITDA. How many times the enterprise value? Whatever Airtel's EBITDA multiple is, my enterprise value will be the same multiple of my EBITDA. It's the same basic logic, so why is this one more famous? Sir, EBITDA stands for earning before interest, tax, depreciation and amortization. What is amortization? Sir, the depreciation of intangible assets is called amortization. Essentially, we are taking earnings where interest and tax have not been deducted, and these earnings are available for the whole firm for both debt and equity. In this, we haven't even deducted the depreciation amount yet. That is, in a way, cash earnings. These earnings belong to the entire firm and are in cash. From them, we determine the value of the entire firm. So this is a more famous method in relative valuation for practical use. Understood? You use this method. This EBITDA, when you use your own EBITDA in it to calculate your enterprise value, you will have to adjust your EBITDA. Take the adjusted EBITDA, just don't forget this. How to adjust your EBITDA? Keep that in mind if there is such information in the question. Take the EBITDA that is given in the question calculated by the company. Now keep in mind, if any extraordinary gain is included in this EBITDA, you should deduct it. Because think, what if you included it? Your company's intrinsic value, so you need normal EBITDA. This EBITDA means we deducted all expenses except interest, tax and depreciation. All earnings must have been taken, even if an extraordinary gain. So remove that, sir. We generally won't have that. That happens only sometimes. If any extraordinary loss has been deducted, add it back, because that generally won't happen. Besides this, if the question states an expense is not written off yet, meaning we haven't put it in the P&L yet, we had to take total earnings before interest, tax and depreciation, meaning to deduct all expenses except interest, tax and depreciation. The question states a 15 rupee sales promotion cost is undeducted. You should deduct it. Exams add such points for complexity, though impractical, so apply them. Remove any pending expense, as all expenses need to be deducted. Example, sales promotion. Similarly, if it says this is an income that is pending to be recognized in the books, then add it. You will get adjusted EBITDA. This adjustment only serves to lengthen the question. Next, come to comparable companies multiple, or the CCM method, also known as CCM. The logic is similar and easy. Understand this method. You will take a similar company, and then for that comparable company, you will identify 4 distinct ratios. Until now, a similar company's multiple was used. We used one ratio and multiple means ratio. This time in this method, you will use 4 ratios of the similar company. Those 4 ratios that you will be taking, and the value that will come from using those 4 ratios. Value will be the value of equity. The value you get here will be the value of equity. In this method, the 4 ratios taken from the similar company are methods that give you the value of equity. You will see now. The question will provide the ratios. Market value to book value, market value divided by book value. This ratio, not in AFM basics, is not a true ratio. You can create any, like market value to expense. The first goes in the numerator and the latter in the denominator. Market value to replacement cost, to sales and to net income. Generally, you will use these 4 similar company ratios. The exam might give other ratios besides these, but these 4 are generally used, and it's fine even if another one is provided. Understand the logic. With 4 ratios from a similar company, how to calculate equity's value? First, you calculate your value from these 4 ratios. You find the market value by multiplying the similar company's market to book value ratio with your own book value. Similarly, do it for the second, third and fourth ratio. You have 4 values. Out of these 4, which should be our equities value? In the second step, our equities value will be the average of these 4 values. The question provides 4 similar company ratios. Use them to calculate and average your equity value. The average value of your equity. Remember one special point in this. I have written in notes. When given a similar companies ratio, it can happen. They give ratios of 2 similar companies. For example, I am Jio, so one similar company of mine is Airtel. And I have Vodafone Idea, another similar company also called VI. If the question provides the market value to book value ratio for both Airtel and VI, market value to replacement cost ratio of Airtel and VI, ratios for 2 similar companies, which ratio will you take? For valuation, you should not pick just one company. Instead, average the ratios of both and use that average ratio. If the market value to book value ratio is available for both Airtel and VI, find the average of this ratio. Use that average market value to book value ratio. The market value to replacement cost ratio for Airtel and VI, just average it and use that average ratio. You will have to do it this way, okay? If the 4 ratios previously mentioned are indeed provided for 2 similar companies within the question, then you must first average each specific ratio from both of these similar companies. After completing those steps, there will be nothing left in the question. Now look the next and the last approach in this method. Relative valuation models, chop shop or breakup value approach. What is this? Chop shop sounds like we are cutting things up or someone's breakup. If a question on the breakup value approach comes in the exam and someone has just had a breakup, they might get depressed in the exam. Don't get depressed. This is a different kind of breakup indeed. So don't start looking for that in everything in the exam. Otherwise, because of that breakup, your paper will have a breakup with you. So it's the breakup value approach or chop shop approach, its function. This approach is used by companies that operate in multiple segments, multiple businesses. Let's say my company has a food division and an electronic items division. I am in the food business, meaning I make biscuits, chips, etc. And there is also a business where I make and sell electronic items like TVs, fridges, ACs, all within one company. A business can have many segments, and for this example, I have simply taken 2. If such a company wants to find its firm's value, then in that particular case, the company divides itself into various segments, essentially like a chop shop. It breaks it up completely. This is a company that has broken itself up into different segments. It's divided into segments and pieces, and that's why this method is called the chop shop or breakup value approach. Company with 2 segments, 1 and 2. This method follows the same process. In this method, you take segment 1. For each segment, you need to find a company in a similar business and take its ratio. Applying that to this segment's data yields its value. For segment 2, find a similar company in its business. Take its ratio, apply it to this segment's data, and you'll get its value. In this way, you will get the firm's value. 3 ratios are employed here, namely capitalization to sales, capitalization to assets, and capitalization to operating income. Capitalization to sales, to asset, and to operating income. Capitalization here is the value of the entire firm. This method will give you the value of the firm, value of the business. Simply put, sales capitalization is a type of sales multiple. And asset capitalization based on total assets and operating income applies to the entire company, ignoring debt or equity. These ratios provide the firm's value, and capitalization here means firm's value. So what do you have to do? First step. Your very first task will be to take these 3 ratios from a similar company. And for each segment, you apply it to the value of each segment. You will get 3 different firm values from the 3 ratios. Then let's take capitalization to sales first. For segment 1, apply the capitalization to sales ratio to its sales to find its capitalization. Similarly, calculate segment 2's capitalization using the sales ratio. Totaling them gives the firm's value. Finishing the first ratio, find the firm's value using the second and third ratios. In the second step, we average the 3 firm values we found to determine the final value, much like the CCA method. The sole difference is breaking the firm into segments. With this, the relative valuation model is complete, and we have finished the most important second part of this chapter. Now let's move to the third part of this chapter, EVA and MVA. That is the third part of the chapter. Now look, let's understand this part quickly. There isn't much to it. This is an extra topic in this chapter. Economic value added, EVA and MVA, or market value added. We will study these 2 topics. The first one is economic value added, which you call EVA. In short, what is EVA? EVA is essentially a method for measuring a company's financial performance. This means the excess profit a company is able to generate above its absolute minimum required return, which is its cost, is precisely what you call EVA. What is it? I'll explain the logic with an example. Then we'll move to its calculation. Understand this because people often don't know what it is, and I am telling you. Let's understand economic value added. For you all to get it, let's analyze its name. Economic value added means first you need to find out what economic value means. Economic value means the benefit a company gets from dealing in goods and services in its ordinary course of business. That benefit is called economic value. The benefit from dealing in goods and services in the ordinary course is just profit and loss. Profit and loss is economic value. Do we calculate the company's profit and loss in this topic? No. We don't calculate profit and loss. It's called economic value added. How much was the addition to the economic value? It means the addition to profit and loss and how much the company added, because EVA is calculated for a particular period. We calculate it for that particular 1 year period. We need to calculate how much we added to our profit in 1 year. So does that mean the profit earned in that year is the addition? No, not so. It's viewed differently. Listen to what happens. Sir, here addition means the minimum required return the company needed, the minimum money the company had to earn from its business. The excess profit a company earns above its minimum required return is termed as economic value addition, meaning it added this much to its profit. Sir, why is it called that? What is this minimum required return? I will explain it in full detail, so now listen carefully. Every business needs a minimum return. To understand this, suppose I want to do business. If I've started a company, I raise money from equity and debt. Now I invest this money in business for returns. So what is the minimum return I want to earn from the business? When you raise money, it doesn't come for free. There's a cost to it, KE on equity and KD on debt. Is this the overall cost? WACC, the cost of capital. My capital also incurs a cost. Assume the overall capital cost is 10% and a total capital employed of 10 lakh rupees. I've raised rupees 10 lakh from debt and equity and the WACC is 10%. In terms of amount, my expense is rupees 1 lakh from where I raised the money. This means from the earnings I get by investing this money, I must earn at least 1 lakh. If I don't earn that much, where will I pay these people from? I'll pay from my own pocket and the company will be ruined. If a company isn't even earning this much, then that company is ruined. It's a useless company. This is the minimum required return for the company. How much excess profit does the company earn above its minimum return? EVA shows that. How much is the company earning above this? We are looking at the minimum required return from the company's viewpoint because we have seen what is paid on both debt and equity capital. So that's it. When looking at earnings, we consider the company's earnings, meaning NOPAT. NOPAT, which is basically EBIT minus tax, represents the company's complete earnings available for both its debt providers and equity shareholders. From these earnings, we have to pay the capital providers, which is their cost. Consider the business profit, assume a NOPAT was 3 lakhs. We had to earn a minimum of 1 lakh because that was our expense on the capital we had raised. So sir, the company's excess profit is rupees 2 lakh. This is our EVA, that's it, the topic is finished. If EVA is 2 lakh, what does it reflect? Listen carefully. This 2 lakh rupees is the company's earnings. NOPAT is all earnings after expenses, excluding interest and tax. Now we had to pay KE and KD. So we paid that from this profit too. So sir, this profit of rupees 2 lakh is the company's own pure profit. This profit is what's left with the company now. It can now either invest this profit in the business. Now by investing it in the business, it can start earning more from it. Meaning this excess profit will now be invested in the business and the company will start earning more money on it. Simply put, if you invest 1 rupee in a business and earn a profit from it. So if you invest that profit back in the business, you earn more because the total investment has increased. If this profit is invested in the business, its value will increase and your company has made an economic value addition. Meaning you added so much to the profit that the company can now invest that extra money back into the business. Did you get it? This is what EVA is. EVA measures financial performance calculated as the excess return earned above the minimum required return. The higher this is, the better it is. It's simple. The higher the EVA, the better it is. That company will be that much better for investment purposes. Now there's one more point written here. The EVA calculation was invented by a US consulting firm, Stern Stewart and Company, and they have registered it. The exam will not ask this, but I'm telling you, so please pay close attention. Every theory, every concept was invented by someone, but we didn't discuss that. Why here? Because I have written the specific words and registered. There's a US firm and one day they had an idea to measure a company's financial performance using the extra additional profit, so they developed the concept of EVA and its formula. They also made some adjustments in it. I've explained the basic formula. And they also made some adjustments and then they got that formula registered. Registered like what you call a copyright or trademark, that was done and registered. And what does getting it registered mean? Now, if anyone in the world wants to calculate EVA, they have to say that we are calculating the EVA that Stern Stewart registered. But apart from this, the adjustments they had made in that formula, which was the exact formula they registered. People will have to apply the formula as it is to do the calculation, and only that will be called EVA. If the formula sees slight changes, even minor adjustments, you cannot call it EVA. All other models can be adjusted by people in practical life according to their needs. They are open and modifiable. As EVA is registered, no changes are allowed even for the exam. The adjustments that the US consulting firm made, we will do them as they are. We will not make any changes. Don't use your own extra brain. The adjustments they made are logical, so there's no need to use extra brain power. You know, some students will try to overthink it. Some people have a habit of doing that. What will they say? These adjustments are all logical and I will explain the whole logic. But regarding those adjustments, students might think another should also be included. We could have done this adjustment too. Look, we could have done anything, but the company that developed EVA, the people, the firm, they registered it as it is. Now you can't modify that formula at all. You can't add your additional logics to it, so don't even think about adding additional logic to this formula. Not even remotely. I had to make this point clear, and for this, some things in this formula you'll have to keep in mind. Let's see the calculation. Take NOPAT, how much did we earn minus the cost company is incurring on its capital. Capital employed will be called invested capital because we will make adjustments. Into WACC. This was EVA for which we saw an example. You need NOPAT, invested capital and WACC, which was explained in chapters basics. Okay, understood? We need NOPAT and invested capital. We know NOPAT is EBIT minus tax, but I mentioned adjustments, so you'll take the adjusted NOPAT, okay? So NOPAT comes from EBIT minus tax. In NOPAT, you have to make one adjustment that the firm made by adding back non-cash expenses. For example, the provision for bad debts, and this will give you the adjusted NOPAT to use. This is a non-cash expense. The company included a non-cash expense in its profit that was never actually incurred. Company has earned a good amount of cash profit. This expense is just showing up because of a book entry. Why consider this? For decision making, focus on the company's true earned profit. Remove the expense that was put in for book entry purposes, add it back. So provision for bad debts, what about it? Depreciation is also non-cash and added, but it won't appear in questions. If it does, then add it, but it doesn't come. The reason behind this is because in this formula you do add back depreciation because it's non-cash. But there is something called economic depreciation which you then have to deduct, and it is a detailed concept that is not part of your syllabus. Institute won't ask the depreciation point. They simply never ask this point, nor is it given. We won't discuss what's not in the syllabus. Just keep this in mind. Now see what those who overthink will do here. How about the non-cash expense? They overlooked the non-cash expenses tax effect. If you're adding back non-cash expenses, do it with the tax effect. So that's the thing, that's the logic here, that you will actually get the tax benefit. And this non-cash expense, you are adding it back because it's an entry amount. The tax benefit is actually received. Additionally, do not make extra adjustments, their decisions are final. Is that clear? After this, sometimes in a question EBIT might not be given. If EBIT isn't provided, how do you calculate the NOPAT you need? You might assume the question is wrong. Profit after tax, which we call net income or net profit, was mentioned in income statement in basics of AFM. That will be given. So sir, you have to do a reverse calculation. When you deduct interest from EBIT, you get PBT. When you deduct tax from PBT, you get PAT. To reverse this, just add tax to PAT to obtain PBT or divide PAT by 1 minus tax rate. I verified this with an equation as you have seen. When you subtract this from PBT, you get PAT. From this equation, PAT divided by 1 minus tax rate, which is PBT. Then adding the interest expense to PBT will give you EBIT. You must use your brain for many things. Study concept notes, as memorizing and solving won't work. If you remember these notes, then the repeated questions from the book will never be wrong. If a new question comes, you will solve it completely. The paper will never seem tough. Remember to always study these notes. So these notes were the most important. I give these notes for free, so they are free for everyone. I offer these notes free because payment would seem like promotion. These notes are free for all regardless of class enrollment. You can easily study from the free website resources. And you will also get revision videos for free on YouTube, even for those who've never seen my class or who just badmouth me by studying from others. But everything is free for them too, so follow it. I'm saying this for your own good. You all will enjoy studying. After this, look, sometimes in a question, EBIT is not given and neither is PAT. Such questions provide financial leverage to calculate EBIT. Remember financial leverage which you studied in Inter. The formula was EBIT over EBIT minus interest expense. But is this in the syllabus? It's not in the syllabus. You just need to know the formula, because plugging data into it finds EBIT by solving a basic math equation. If you recall the financial leverage formula, you can solve it with basic math as demonstrated. Or if you don't know basic mathematics. Then I had also directly said, how can you calculate EBIT? If I solve this very equation, EBIT will be financial leverage into interest expense divided by leverage minus 1. So now about EBIT. This is done to make the question a bit difficult, although it's not difficult if you know this process. We have NOPAT and WACC. Let's look at invested capital. It is simply capital employed, and multiplying it by WACC provides the minimum required return. It must be capital employed. Because sir, we will make some adjustments to the capital employed. So if you make adjustments to something, you can't give it the same name you were calling it before. Let's say you all have my question bank. Instead of getting my question bank from my website, you picked it up from somewhere in the market. He added 2 chapters from another teacher's book at the end of my question bank. So now you can't call it my question bank. You can call it a mixed compiler or whatever, but you can't call it my question bank, Ajay sir's question bank. You can't say that, right? So it's the same thing when you make some extra adjustments to capital employed, you can't call it capital employed anymore. It has become something else, so they have named it invested capital. You can calculate from 2 sides, liability or asset, same result. Capital employed also came in 2 ways, I told you in the basics. Equity share capital plus reserves and surplus plus debt. So capital employed, equity share capital plus reserve and surplus plus debt. Or the other way, total assets minus current liabilities. If you do this, it will be same. From the liability side, to calculate capital employed, simply add these 3. You have to make 2 adjustments if available. First, intangible assets, meaning patents if they are not recorded in the books. If unrecorded, their inclusion would increase total assets and capital employed, since it's total assets minus current liabilities. We added that. Besides this, non-cash NOPAT adjustments, for example, bad debt provisions, must also be added here. Why was it added here? Listen carefully to its logic. We adjusted non-cash expense because it's only a book entry, not real expense, so add the profit back. But sir, profit was low in books. The profit was low, and that amount naturally goes into reserves and surplus. Reserves and surplus holds profit with non-cash expenses deducted. We are saying non-cash expenses shouldn't have been deducted, and if there were no such expenses, profit and reserves plus surplus would be higher. Added then, right? Understood? For asset side calculation, take total assets minus current liability, so share capital plus reserve plus debt. Similarly, plus intangible assets like unrecorded patents. It comes in question. And add the non-cash adjustment from NOPAT, which means both the intangible asset and this adjustment are added here. Why the non-cash one? Now listen. You should know how to pass accounting entries. Then the logic of this adjustment will be clear to you. You learned accounting in 11th grade. For example, consider provision for bad debts. Entry was P&L to provision for bad debt. One adjustment was made, P&L meaning expense. Second, to provision for bad debts was creating a liability of sorts. We compute total assets minus current liabilities, removing all current liabilities. This is also being deducted. If we assume this non-cash expense didn't exist, and since no liability is created, it just won't be deducted. You deducted it because it was a book entry, then added back. Another example for this, according to depreciation. The entry is depreciation to machine. Depreciation expense adjusted in P&L, and for the machine it implies that. Will it be a fixed asset balance? Our total assets are reduced by depreciation, yet as non-cash this should simply not occur. Without it the machine's balance is higher, so you add it back. I've explained the logic, just remember it properly. That's it. Calculate EVA. Adjustments are made. Keep in mind other points about PVA. They are sometimes asked. A company with a higher EVA is considered the best investment. Suppose you have 3 companies. Consider the company with the highest EVA for investment as its best and can invest more profit in the business. After this, EVA dividend. What is EVA dividend? EVA dividend means if you distribute the EVA you calculated as a dividend. Then what will be the per share dividend for shareholders? Let's see an example. Let's say the company's EVA is rupees 2 lakh. The company's EVA came out to be rupees 2 lakh. With 1 lakh shares, that comes to 2 rupees per share, which is the EVA dividend. If company is distributing 2 rupees per share as dividend, it is called EVA dividend. What does EVA dividend truly mean? It indicates the amount of dividend a company can actually pay before its overall value begins to decline. Meaning the company can pay a dividend of rupees 2 per share to its shareholders. If it pays more than this, the company's value will start to decline. A company's value will decline if it pays even rupees 2.1 per share. How will that happen? Why will value decline? The company has an excess profit of 2 lakh rupees, and because its capital providers have been paid, it can distribute this as an extra dividend to shareholders. If distributed more than this, then the company will have to pay out of its own pocket. When no profit remains, paying from pocket causes the company's value to decline. So this is its interpretation. I will tell you one more point about this in more detail, which I have told many times, but we are unable to make the linkage. We are not able to interpret it properly. Now look, minimum required data is subtracted from NOPAT, resulting in EVA. This 2 lakh dividend we are discussing is for distribution to the shareholders. What if the company doesn't distribute it? Company value won't fall. Will not distributing dividends anger shareholders? It's not like that. Shareholders shouldn't get angry. They won't, because the minimum required return has already been deducted. That return included both KE and KD, and KE is the investor's expected return, as I told you. How much return do they want? We have already given them what they expected. We are talking about giving extra for their happiness, to make them even happier. Distributing this, it is not a problem, it's for their happiness. More than this reduces value. The company has 2 choices for this dividend: either distribute it to their shareholders for their happiness, or invest it in the business, or simply invest it in the business to earn extra profit in the future. If it invested in business, how will it earn more? If money is invested in the business, then the business grows by the amount invested. That's basic. Growth drives EBIT increase, higher EBIT then boosts FCFF, the primary valuation model. It's based on EBIT, and the higher the EBIT, the higher the value of the firm. This is its conclusion as written for EVA dividend. This is the dividend amount a company can pay without its value declining, because if no dividend is paid, the firm's value then increases. Since the amount can be used for investment, which will increase EBIT growth. Hence, if EBIT becomes higher, the value of the firm will also increase. I have explained this to you. EVA is complete. Next is market value added, MVA. MVA signifies the total wealth a company has been able to create for its stakeholders right from its very foundation. Meaning, how much wealth has the company been able to create for its stakeholders from its foundation till date? How much value has the company increased for its stakeholders? We are discussing this, meaning since its foundation. Now consider the difference between stakeholder and shareholder. Shareholder means equity. Stakeholder means both equity plus debt, whoever the stakeholders of the company are. So for everyone, that is how much value has the company been able to create for everyone since its foundation, since it started. How much addition has the company been able to make to its value? This is called market value added, the addition to its market value. Meaning the company's current market value versus book value defines market value today. This calculation is simple. This was developed by EVA's developers, so the linkage will be similar here as well. The institute has 2 methods to calculate MVA. While one method is standard in the market, the institute employs 2 specific approaches, and we will examine both. Which method applies when? It's written in the question, yet students ask. I had covered it in the class. I will explain this using the question. If the firm's market value is given in the question, if firm's value is given, use that minus the value in the books. Is capital employed? No. Take the adjusted invested capital, because EVA's creators calculated MVA. So just deduct that value of firm minus adjusted capital employed and invested capital. You will get MVA. If the market value of the firm is not given, but the market value of the equity shareholders is provided. So how to calculate? Take the equity holders market value, which is MPS times the number of equity shares provided in the question. Now from this deduct the invested capital. Don't make this mistake. When you take the market value of equity, you are saying how much value addition has been made for the equity holders. Then deduct only the book value of the equity holders, which is the shareholders fund, meaning equity share capital plus reserves and surplus. The value in the books is from reserve and surplus. Market value represents this value addition for equity holders. Which method to use? Just check the question. If the firm's market value is given, then this one is applied. The firm's market value is not given. You are given the value of equity, market value of equity, market price of equity. So apply this one. Market value of the firm means we've studied various firm valuation methods and applied them. That will be given to you. That was all about MVA. Inside MVA, there is one last point. You can also find the value of a firm using MVA. The firm's value using MVA is calculated as MVA plus invested capital. Now simply look at this main formula here. MVA is found by subtracting invested capital from the firm's market value. To find the value of the firm, MVA is here, minus invested capital went to here and became plus. So MVA plus invested capital. So sir, this has become a cross reference. A circle has been formed, what you call a circular reference in Excel. Circular reference. Because the firm's value came from a different method than previously studied. Removing invested capital yields MVA. This is for finding the balancing figure. MVA is a balancing figure. Given MVA, add invested capital for the firm's value. It is a balancing figure. Apart from this, by using MVA, a particular value can also be obtained. Is there another method to calculate MVA? It's required, and the institute follows a distinct approach. There is also a proper method to calculate MVA. If you use that method to find the value of the firm, you get a very good and proper value of the firm. That people generally can't follow that in practical life because it becomes even more complex. Another method for MVA isn't even asked in questions. Find out all the future EVAs, estimate them, and then compute their PV with WACC. That will be MVA. Basically, you estimate the future EVAs, okay? Estimating future EVAs is risky. Unlike cash flows, EVAs need adjustments, and annual WACC is a big problem. This is why this method is generally not used. Future EVA, the economic value, indicates the profit addition available for business investment. If we get the future economic value, we calculate its PV, as business value increases only with its growth. Calculating the PV of future profit to be invested shows the increase in the business's value, which means we will get the MVA. Estimate future PVs, then calculate their PV. Use WACC. Since EV represents the business, the WACC capital cost for PV must be WACC. MVA is covered, add invested capital for the firm's value. Questions on this are rare. With this third part is also complete. It was a simple part. The last part, part 4, other topics. Generally, no question is formed from this part, and it often doesn't come in the exam. In this part, there are other topics in this chapter related to valuation, the valuation topics we discussed in the second part. But how will you do valuation in some specific businesses, some specific types of companies? When there is a specific business, the general approaches to valuation that I told you about in the second part will apply to all companies. But there will be some specific businesses whose nature will be different. So in them, you do apply those valuation methods, but you customize them a bit, you do some extra things in them. That's all you have to do, for which I gave an example. When you go to the market, you will find many tea shops. The basic fundamental of making tea is the same. In tea, you add water, milk, tea leaves, sugar, whatever you want to add. These are fixed things. But one shopkeeper adds ginger, another adds cardamom, and another adds their own special spice. So everyone has their own specification. The general approaches to valuation will apply to all companies, but there will be some specific companies. You will apply the general approach, but it will involve modifying it slightly and also adding some extra elements to the basic approach. We will use the method, the general method. These are not useful because separate questions are not typically formed from them. However, in some instances, I will explain with an example from the regular lecture. I had done it with an example question. The example questions are not from the institute. There won't be much in this. If you complete the second part and solve all its questions, then this part will be done automatically because you have to apply the same methods with a slight change. And there is nothing else. Now let us look at this fourth part quickly. In this fourth part, you will study 3 topics. First is valuing digital platforms. How will we value digital platforms? As they are specific businesses, their valuation requires keeping extra things in mind. So digital platforms are a specific business. Digital platforms are a specific business, and their valuation approach you will learn here. First, tell us what a digital platform is. We don't know that, sir. That's what I have written. You will understand digital platform from its name. Digital means online. Today you know the meaning of digital very well. Modi ji has made the word digital famous anyway. Okay, online platform, meaning the online platform, the digital platform. So the online platform businesses, that is such businesses who work online and whose entire space and entire infrastructure is also online. They exist and operate entirely in the online space, conducting only online transactions, in which the users go to the online platform, to the online infrastructure, and they actually interact and transact right there. Users interact with each other or directly interact or transact with that digital platform. So this digital platform is software based. Since it's online, it will be software based, online infrastructure for interaction and transaction between users. This definition is not for exams, but it's for your understanding. Some examples to get more clarity. You will get clarity from the examples. For example, Amazon, Uber, Google, YouTube, WhatsApp, Telegram, LinkedIn, Paytm, Netflix. These are digital platforms. Amazon's online platform offers products. You place orders, create accounts, and all tasks are done digitally. Similarly, Uber is an online platform. You go to the app. If you want to book a cab, you book a cab. Similarly, Telegram is an online platform allowing users to chat or video call through their numbers. After this, Paytm for online transactions like UPI, etc. Netflix has so much content of movies, web series, consume as much as you want. Their entire infrastructure is online, so for these digital platforms, general valuation approaches cannot be applied directly. You will have to make some changes. Keep understanding the reason why. In the general valuation approaches, the market price method is a market-based model. It was useless, so completely discard it. For the other topics, we'll set the market-based model aside since it's useless, although the institute does follow it. Second, asset-based model. What's the point of an asset-based model here? You just can't value a digital platform with it. If you go to Netflix and ask them to show you their physical assets, what physical assets? Their entire platform is online. Valuing digital platforms cannot be done on an asset-based model, as I gave my own example. My institute is also on a digital platform. In that you saw the asset-based model, it was of no use there. Asset-based model isn't useful for digital platforms either. The income earning based model, cash flow based model. The income earning and cash flow models are always applicable and useful, with the cash flow model being most famous. This is useful everywhere. Always useful being part of the income earning model, it's written separately. So now these two models, apply them as they are for the valuation of digital platforms too, just as you did for other companies. If you have to do Netflix's valuation, if you are applying the cash flow model, then apply it the way you did for other companies, FCFF, FCFE, whatever you did, it will apply. Nothing is different, just keep two separate points in mind. Now I'll explain with an example. First point, find cash flows or profit. By estimating the share of our digital platform, which you will call SAM in TAM. What is this, sir? SAM TAM. Listen. This is for practical life, not for the exam. You have to estimate future cash flows. But if it's a earning based model, then future profit, I'm telling you according to cash flow. You have decided on FCFA, FCFE, whatever model you have decided, you estimate the cash flow according to that model. So to estimate future cash flows, it's explained how to estimate them in the case of a digital platform. They have said that you should find out the total addressable market. What is the total market of the business you are in, which is called TAM, total addressable market? Don't remember anything, I've just written it in short. Remember TAM. What is the total market? Consider Paytm for instance. For now, assume its sole business is UPI transactions, nothing else. So look at the total market of all the platforms in the UPI transactions business. What are the other platforms? Google Pay, Phone Pay, Bharat Pay and other pays, I don't know how many today. All these are UPI transactions business. So well, all of them, they are also taking a share in the market. What is the total market for UPI transactions? Assume its total addressable market is 100 crores annually. That 100 crore is the total addressable market. You estimate your share in this. I estimated, sir, my share will be 20% of the entire market. So 20% of 100 crore is 20 crore and that's my cash flow. This is the method. So your service is called SAM. Serviceable addressable market, it means out of the total market, what portion can I actually serve? What will my share be? That's called SAM. For practical life and for the exam, the most they will do is, will provide you with the cash flow in the question. The total addressable market is this much. They will tell you your share, maybe 20 or 10%, and you calculate the SAM, which becomes your final cash flow, and you then calculate its PV. This is the maximum modification. Is a separate question needed? No need, these questions appear. Also, there is an extra point to keep in mind. Company specific risk premium is added to the cost of equity. You also have to add the company specific risk premium to the cost of equity. For PV, cash flows need a discount rate. If it's FCFF, use WACC, meaning you need KE. And if it's FCFE, you need KE, which is calculated as RF plus beta times RM minus RF. You know the RF portion in this formula. We take the RF portion for a reason. I have already explained that you get this much return risk-free, so we will definitely demand that much. If we invest money in a company, there is risk, so we will demand a risk premium. When you value a digital platform to calculate KE, you will use the standard formula, but you'll also add CSRP, the company specific risk premium. These digital platforms have a separate specific risk premium associated with them. It's an extra risk unique to them. You will also demand that return because they carry more risk. Consider, for example, Paytm, a UPI platform. These platforms carry significant risk. First, there is a lot of competition these days. Second thing, these digital platforms can have bugs related to security or anything else. It's UPI platform. And if one day a security bug occurs, a customer might want to make a payment of 2,000, but 2 lakh gets debited from their account instead of 2,000. Then the company will be ruined overnight. It will be destroyed in a single night and crash completely. Thus, you have a company specific risk premium. Just like I gave the example of Netflix. Netflix provides movies and web series online. It's the security part if you see. The security aspect of Netflix, if that becomes extremely weak. Suppose their security becomes extremely weak. Then that means anyone can easily access and take all of their movies. All the web shows, web series, everything. Who would bother? It shuts down. Do you understand? Demand a higher risk premium for them. Remember these two extra points. And rest it's complete. The question will be like this. And if CSRP is given separately, you must include that in KE. Relative valuation applies universally. You can find a similar company for anything. And for Paytm, Google Pay and others. Take their data and ratios, apply them to your company and get the value because the method is the same. Besides this, another approach is given. It's the cost approach. The value of a digital platform can be calculated from its total building cost. This approach is useless and impractical. In this, the platform's value is its total building cost, and the Netflix cost was 1 crore and this building cost means the total cost in these platforms. It's the cost of development or coding as its software. If we follow this cost approach, then I'm ready to buy Netflix for 1 crore today. There's nothing wrong with that, right? This model is useless. Is it even one? Nobody follows the cost approach. With that, digital platform valuation is complete. Now let's move to the valuation of distressed companies, a much better topic where you'll see some extra things. You must apply your own mind. Otherwise, it's easy. There is nothing to be afraid of. Some people make it sound scary. They do and they still are. They make it sound dangerous, but it's very easy. I'll explain it with an example right now, and you won't even need the revision video. To value distressed companies, we first need to understand their meaning. A distressed company means it's a company that is in a state of extreme sorrow and severe pain. If I were to give the Hindi meaning of distressed, it is extreme sorrow or severe pain, a company in tremendous grief. Stress means a person is in sorrow. Distress means they are in immense sorrow, that's all. Consider it from a normal person, forget companies, focus on an individual. When a person is in deep sorrow, when something happens to them, you can see in today's world even school children fall into deep sorrow. They reach the point of suicide. If someone leaves them, they don't understand. Or let's say a normal person has taken a loan from the market. Unable to repay his invested and lost money, lenders visited his home verbally and physically abusing him, leading to immense distress. Then that person went into immense distress and sorrow. Now that person wants to end his life by hanging from the ceiling fan. So this is being in distress. It's the same with distressed companies. What are distressed companies? Companies that are unable to meet their financial obligations and in immense trouble. When is it in immense trouble? When the company has taken on debt and unable to make debt payments and cannot pay its operating expenses. So because of this state of distress, I can ruin my life at any moment and I can shut down my company at any time. Because shutting down the company simply means that the company will go bankrupt. The company will declare bankruptcy having nothing left. Shutting down means going bankrupt. A distressed company is one that cannot meet its financial obligations, which means it could go bankrupt at any time. Such companies are called distressed companies. So why teach the valuation of a distressed company? It's already ruined. It cannot meet its financial obligations, which means they raised money. They invested money but are unable to earn a return. Perhaps they lack business acumen or for other reasons cannot generate profit and pay back their capital providers. They exhausted their funds, now have nothing left. So what is the point of valuing such a ruined company? It won't have any value, will it? You would say a distressed company is worthless. But that's not the case. A distressed company can also have value. This point is written here just to make it clear in your mind. It does not mean that a distressed company is worthless. It may also have some value. A distressed company can also have value. How is that possible? So you have to look at its future capacity, and what the company did in the past truly doesn't matter. Can this company generate cash flow in the future? If it generates cash flow, money will come in, and if money comes in, it can make payments, which means it has value. Focus on its future potential. What was done in the past is a historical and sunk cost. I keep telling you this. Students might feel their syllabus incomplete, lectures continue and exams near. Now you're in immense state of very deep distress. Your mind is stressed, you feel like your life is ruined. But it's nothing like that. What you've done until now is past and focus ahead. In the coming time, prioritize studying and covering the syllabus. If you do that properly, in the time you have left, you will come out of this distress and become a normal person. But if you don't, then your situation will be just like a company going into bankruptcy. Because the past never matters. I always say that historical cost is a sunk cost. So what you did in the past is not relevant for decision making. So forget about it. The time you wasted, whatever happened, just forget about it. What you can do in the future is what will decide your result. For a distressed company, its future decides its value. So in the valuation of a distressed company, the main model we will use is the cash flow based model. I will teach you 4 methods for valuing a distressed company, and 3 of them are cash flow based models. 3 methods are based on the cash flow model. The other one is the relative valuation model. The relative valuation model is similar to other companies. Is it the same? How can it be? It's a distressed company, so will there be others like it? Absolutely. Your preparation isn't done and you're in distress. Countless other students are like you. You are not alone. Don't think that. Similarly, a distressed company is not alone. Many others are available. Just take similar company data and find the value. The market price based model is useless here. Where would you apply the asset based model? If the company had assets, it would have paid its dues. So that model won't apply. And that's not there either. The cash flow based model is the most important. The income or earnings based model is part of it. Thus it's included here. Therefore, the most important is the cash flow statement. So the cash flow based model will be used. It has 3 methods. First, the modified discounted cash flow method. In this, you need to first recall the cash flow based model explained for general companies. We will build on that concept, and if you didn't understand that, then this is pointless. You might as well stop studying. You won't understand this without prior part. You choose the method, whether FCFF or FCFE for firm or equity value, then calculate accordingly. Now what is the change? You will modify it. You calculate the PV of future cash flows, whether FCFE or FCFF, and the process is the same, just modify the cash flow. You have to modify the cash flows. It's the same as the cash flow based model for other companies, except that the expected future cash flows are calculated. How will you calculate the expected future cash flows? The expected future cash flow for a time t is calculated as cash flow of time t multiplied by 1 minus the probability of distress of time t. What is this and its logic? Let's understand with an example. It will be easily grasped. Look, you are given a company. It's a distressed company. For the next 5 years, it can generate these cash flows, and we want to perform valuation based on FCFF. We'll do the valuation based on FCFF. For FCFF valuation, the process is largely the same as what you studied for general companies in the cash flow based model. Just apply those steps. The FCFF for 5 years, and it is 1000, 1500, 900, 700 and 1200. WACC gives PV factors. Use these to find the firm's value, standard for normal companies. Given this is a distressed company, what will do? Modify these cash flows applying the modified cash flow method. What's modifying mean? Now listen carefully, and in such a question, the probability of distress for each year will be given. Probabilities 0.20, 0.1, 0.4, 0.15, 0.15. The total of probabilities will always be 1. The probability, the 0.20 means 20%. So what does the probability of distress mean? It means the probability that the company will go into so much distress that it shuts down, goes bankrupt and is finished. What is the probability of the company shutting down? Since it's distressed, it can shut down at any time. I assume it will survive if it generates future revenue. The valuation assumes survival, but there's no guarantee because a distressed company can shut down anytime. It can shut down in any year. For each year, you see the distress probability. For the first year, there's a 20% chance the company will shut down, and 0.20 simply means that 20% chance. That's the distress probability. So if the company shuts down, will there be any cash flow? You won't get any cash flow then. Cash flow will only come if the company continues operating. The cash flows assume normal going concern, generating only if the company continues to operate. 1000 cash flow for the first year comes if the company operates. If distressed and shut down, it's not received. Second, if there's a 20% shutdown probability, it means there's an 80% chance the company will continue to operate. So 1 minus 0.20 is 0.80, meaning an 80% chance the company will survive. Cash flow of 1000 is generated only when the company is operational. To find the probability weighted cash flow, multiply 1000 by 0.80. For the second year, cash flow is 1500. A 10% chance of the company shutting down implies a 90% chance of continuing. Calculate modified cash flow, then its PV for firm value. This method is quite easy. There's nothing to fear despite what people say. There's nothing to be afraid of, it's basic. You need to know the main method, and I will tell you the extra things you need to do. Let's see next method. Cash flow valuation plus distress sale value. What does this method say? It says to apply the cash flow based valuation that you normally do for general companies as it is. You should apply it as it is, assuming that it's a normal company. Calculate the value as a normal going concern company with the usual method. So simply use the normal cash flows, calculate their PV and find the value. plus the distress sale value is separate. In this method, you will calculate the value using the cash flow based model, whether FCFF or FCFE. For FCFF, the firm's value calculated using the cash flow model is the same as for other companies. Don't modify the cash flows at all. Take the FCFF, take the WACC and calculate the PV. Multiply this by 1 minus distress probability. To this, add the distress sale value multiplied by distress probability. This yields the distressed firm's value. Now let's understand its logic. Understand the logic and let me give you an example. The value calculated using the cash flow based model, for example 1000, was derived by calculating the PV of future FCFF using WACC, and this is the normal process you have followed. So it's the same process. Multiply this by 1 minus the distress probability. Now in this particular type of question, only a single probability of distress will be provided for this method. The previous method gave annual distress probabilities, but this method provides only one for time 0. Why is that? You first calculate the value at time 0 using normal future cash flows and their present value. So we found out that today's value is 1000. So if the firm's value today is 1000, what does that mean? This is the value if the firm operates normally as a going concern. But this firm is distressed, it can shut down at any time. We get this value of 1000 if the company continues to operate. So suppose probability company will shut down. Distress probability is given as 40% or 0.40. So 1 minus distress probability gives 0.60 for operation. The resulting value is 600. We just did the probability weighting here, nothing else. We'll get this value only if the company operates. But if the company shuts down, then upon shutdown, we sell whatever few assets we have in the market. We get a distress sale value. From this, you'll receive some money, usually a small amount, which will be given in the question. For instance, suppose you get 200 from a distress sale if you sell it today. Distress sale probability, it's 40%. So if a distress sale occurs, you will get 200. You will get it only if there is a distress sale, right? What is its probability? 40%. So the probability weighted value is 80 rupees. This is distressed firm's final value. The time 0 value if the company continues to operate is 1000 and its operating chance is 0.60. And if the company shuts down at time 0, its value will be 200 and the chance of that happening is 0.40. So you get this value. There's nothing to this method. And how will a question appear in the exam? They'll give future cash flows, normal ones. You'll have the WACC for PV calculation along with today's distress probability and its sale value. Can you solve it? If this question appears and you still can't solve it, then you'll say the paper was tough. You'll say you were asked an out of the box question that has never been asked before. Then what can I even say? If I repeat myself, you'll feel bad. These days people don't have much tolerance left to hear anything. If you study logically, everything will be very easy and you will have no problem. This method is complete. We'll now study the final topics method. The adjusted present value or APV method is good, so pay attention here. The APV method is used for calculating value in many situations, and we will also see it in other AFM chapters. First, I'll explain its role in this chapter as it is covered in more detail elsewhere. It's not in detail here. In the APV method, you first find the company's value without any debt. If this company never had any debt, then what would its value be? No debt in the company. Without debt, the cash flows would be FCFF. With EBIT and no interest, it remains FCFF. Any future FCFF. For FCFF PV, what do we use? WACC? Don't make that mistake here. Here your company will have debt, but you are just assuming what if there was no debt. So when you are assuming there is no debt, in this case, you should do the PV using KE. Calculate PV using KE because we are assuming the company has no debt. The question will provide the WACC which includes debt, but don't use it for the PV because we are only assuming KE without the debt in this model. The cost of equity would be the company's only cost. So you take the FCFF and calculate its PV using KE. This is the first step in this method. And after this, we add or subtract the effect of debt. Think about it. What is the thought process in this method? The company is going into distress because it has raised money through debt. If I hadn't raised money through debt, I wouldn't be in such immense pain and distress. Because money was raised from debt and you have to pay the debt holders. They come to your house, abuse and beat you to get their money back. That's why I'm in distress. If I had raised money only from equity, it's simpler because they know the investment is at risk and their return is based on the company's performance. But debt holders demand their money back. And so we are now looking at exactly how much peace of mind I would have if I had never raised any money through debt. First, I calculated that value. But the reality is I have debt making me a distressed company. So what effect does this debt have on my value, a plus or a minus? Because of debt, it's negative or positive. Debt has two effects, an advantage and a disadvantage. What's the advantage? Because of debt, you pay annual interest resulting in tax savings, and interest expense is tax deductible. So you save on taxes, called a tax shield. We call this a tax shield, which I have explained. Every year there will be tax savings on the interest. Annually, tax savings on interest will occur. For its value at time 0, you simply calculate the PV of those savings. How do we calculate PV? We discount tax savings on interest at the pre-tax cost of debt. Detailed APV method discussion comes in another chapter. Since there are tax savings on interest, you directly use the pre-tax rate for discounting. The discounting rate should match the cash flow. This is a debt advantage and it will be added. However, debt also brings disadvantages. Due to debt, I became a distressed company, so subtract that loss, the expected bankruptcy cost. Because of these debt holders, I became a distressed company, and because of this, my company can go bankrupt at any time. So due to this potential bankruptcy, what cost is the company incurring? What is the loss to the company? You have to subtract that. So how then do you calculate that previously mentioned expected bankruptcy cost? It's company's value without debt minus distress sale value multiplied by probability of distress. What is the actual value of the company without debt, which we have previously calculated? So what's the value of company? Minus, because of debt, the company is distressed, so it can be sold in a distress sale at any time. The value would be higher without debt, but since it's distressed, you get a lower sale value, and that difference is the loss from debt. This loss from debt occurs if the company becomes distressed and shuts down. Multiply by the probability of distress. Expected bankruptcy cost, I'll explain this with an example for better clarity. It's very easy. First, calculate the value of the company without debt. The question will give you FCFF data, but remember to use KE for discounting because we are assuming no debt. Without debt, KE is your cost of capital, giving you a PV of 1000. You would have that peace of mind without any debt, and because there is debt, we must adjust for its effect. Future interest on debt creates tax savings, so you calculate the PV of those savings because it's a benefit. If it's a benefit, you add it. I calculated the PV of the tax savings on future interest payments and it came to 300, we'll add it. But debt's disadvantage is the risk of bankruptcy, so what is that loss? If there were no debt, the company's value would be 1000. But due to debt, the company might be sold in a distress sale, and if it is sold, how much money will you get? 200. There is an 800 loss because of this debt, a loss which would not exist if there were no debt. This is the loss from debt. This loss will only occur if the company gets sold in distress. The probability of distress is 0.20. A 20% loss probability means 800 multiplied by 0.20 equaling 160. Since this is a loss, you subtract it. This gives a net plus 140. It could also be a net. For example, if the probability were 0.40, then you would get around 320. Then this is minus 20, which you adjust, giving you the distressed company's value. It's a simple concept, I've explained it. Exam questions will provide normal cash flows and KE, making debt-free company valuation easy. For the effect of debt, you must calculate, and the question will provide the interest amount on the debt. They'll give tax rate, so find tax saving by multiplying interest by tax rate. For future tax savings is time 0 value, use pre-tax. Cost of debt to calculate the PV. So you will get this value. This part. Next, calculate the bankruptcy cost using the value without debt. Distress sale value and current probability of distress will be given. So you can calculate it easily. It means it's a very easy method. Your approach just needs to be correct. Don't make mistakes, just logically follow what I have explained. Don't try to overthink it. If you watch random videos that try to give you extra knowledge or scare you, just stay away from them. Then you won't have any problems. And so, distressed company valuation is complete. Now let's discuss startup valuation. How to do valuation of a startup? See, what is a startup? A startup is a company that is in the initial stage of its business. They have just started their business. There hasn't been much growth yet, but there is potential for growth. Moreover, startups are established to provide unique products and services to their clients. You provide unique products and services to clients, solving their problems with new products. You provide unique products and services. The business is in its initial stage, and then you call it a startup company. So how do you value startups? There are many methods for this, and they are completely different. You know what has happened these days? The term startup has become a joke. Many so-called founders come into the market who know nothing. You can make them talk nonsense. Listen for 10 minutes, you'll understand how much this person fools people. These days, many startups are launched by tea sellers, including BTech, MBA, and BBA graduates. Golgappa and Pani Puri sellers are now startups. This world's direction is truly foolish and those promoting them are more so. Going to them and saying, this is our startup guy, they are even bigger fools. The biggest fool watches and seeks progress by their example. So how much madness is this? A startup should provide unique products and services, but many today are just named uniquely. If you look at it, it's a kind of foolishness. So what can be an example of a startup? Suppose one day I decided to do business and start a startup. So I have seen that people have a major problem. If I solve it, I will build a very strong business. I want to build such a machine. A machine that instantly makes desired food. For example, just order pav bhaji and it makes it. If I say make dosa, it does so. Just specify the item and the machine will instantly provide it. I have to make a machine and I have the complete calculation in my mind of how such a machine will be made. People just have to put material in machine once and whatever order you give, the machine will make and provide it. If I make this machine, I can do business with it in the market. This idea came to my mind. I want to do this startup. Now write down the methods of startup valuation. In this way. In startups, the market price method is completely useless. Next, the asset-based model isn't applicable for startups given their initial phase. After this, the cash flow-based model will be majorly applied. But besides this, there will be some extra models in startups. There will be a relative valuation model and some extra models too. Now let's discuss the first extra model, cost to duplicate. What does this method say for us? It explains the cost that you will incur to set up the startup. All those initial costs incurred. What expenses will be incurred for product development in the startup? Expenses for initial physical assets purchased in the startup along with other incurred costs determine its value. This method is applied at the time of initial funding. Look, the people who do startups, people who have an idea but no money will initially seek funding for their startup. We will study a chapter, Startup Finance, to understand in full detail how a startup raises money. So understand here, in my company, I had an idea to create a product like this, but I needed money, funding. So I went to people to get funding for my startup. So look, you want funding, it's still in initial stage, how will we do it? So I said, look, to set up my startup in total, to set up this business, I will need an expense of 1 crore. The startup will also be set up and I will also develop the product in it. Any physical asset that I might require in my startup, I will purchase that as well. So he said, let's set valuation at 1 crore, whatever will be cost to set up startup once. This cost to duplicate approach is generally used during initial funding. Beyond this, there is nothing. The exam question will list costs for a startup setup. Initial cost required, product development cost. Purchase of physical assets cost required. Total all three and you'll have your final cost. It's valuation of startup. So what question will be formed? Next, Burkos approach. The Burkos approach, students, please look at the name. The people who invest money in startups. Those are firms whose business is to be venture capitalists. So they named it the Burkos approach after their firm, the ones who developed this method. How is a startup value calculated here? They said according to them, according to this method, a startup indeed has 5 key factors. If a startup achieves success in these 5 key factors, then that startup will grow easily. That startup will experience tremendous growth if it achieves the 5 key success factors. If it achieves success in those 5 key factors. What are the 5 key factors in this method? Technology execution, strategic relationships, and production and sales. So according to this method, you estimate the startup's value based on these 5 factors and the total is the estimated value. In exams, it's easy and useless, yet practically dangerous. What will happen in this method? These are 5 key factors of startup. So for valuing a startup, I will see what its basic value is. Suppose it's the same machine that automatically makes food. I saw that a basic valuation of 50 lakh rupees is assumed. After this, now give an estimated value for the technology. By its technology, we mean the technology it has to develop that machine. Does it even have it? Technology exists, assume valuation 2 crore rupees. After this, how good is the startup's execution? Because it has the technology, but its founders don't know how to run the business. They won't be able to run it that well. Its value was 20 lakh rupees. Next, what are the strategic market relationships of this startup? That is with the distributors to whom they will supply the product later. These suppliers of raw materials. If their relationships are bad, the business cannot run properly. It was decent, so I valued it at 1 crore rupees. Its production and sales. How many units is the startup producing and how many units is it selling? More units produced mean more sales, justifying further production. For its initial phase and current production, I valued it at 30 lakh rupees. So just total this 4 crore is the startup's value. You estimate the value of the 5 key factors and their sum is the startup's valuation. In the exam, you'll be given the values for these factors and you just need to total them to find the startup's value. Complete. Look at the next method, comparable transactions. You'll understand that a startup's value is based on similar startup valuation. Therefore, you need to find a similar startup in your business. Whatever its value was, if it was already valued, use that as a base to find your value. Comparable transaction method, a relative valuation model. Relative valuation. Here's an example. A Limited is a startup with 10 lakh users. What kind of startup is it? Logistics business. The big companies in the market, when they had to courier their products to their customers, there were some PN codes where DTDC went for others delivery, and for some express Bs, meaning no single fixed courier service existed, and so the companies faced problems. So I thought I'd solve this problem by starting a logistics business company. I told everyone to give me their products and then I will send them to any desired pin code. I will integrate with all the others. The delivery partners, DTDC, delivery express Bs. Wherever we have to go to whichever pin code, all that headache will be mine. So I started logistics business, A Limited, and I have 10 lakh users, which means clients. B Limited is my similar business startup, for which I'll take the example of Shiprocket. Shiprocket does the same business. B Limited has 2 crore users in the market, and B Limited also had a valuation of 26 crore rupees. B Limited's valuation. What was B Limited's per user valuation? Because they got 26 crore rupees for 2 crore clients, the valuation is 13 rupees per user. Since I have 10 lakh users, my valuation becomes 10 lakh into 13 rupees per user, which is 1.3 crore. This is the method, and these are the questions you can expect. Next, scorecard valuation method. Let's quickly understand the scorecard valuation method. It's relative valuation method. You use data from a similar company, and here's how you do the calculation. In the scorecard method, you use a scorecard. You create a scorecard for the startup, which is like a mark sheet, just like your exam mark sheet. So many marks in FR, so many in AFM, in audit, in DT, in IDT. Similarly, you create a scorecard for your startup. You will give a startup marks in different fields. The question is how and in what areas. You create a scorecard based on the quality of the startup. So in the first step, you create the startup's scorecard for the scorecard multiplier percentage. So the qualities of the startup. So you will give marks based on 7 qualities for this. First, the strength of the team. That is the startup you are talking about. Let's say I was talking about the machine one that makes automatic food products. So its founders, if they don't have strength among themselves, if they don't get along, they keep fighting, will it last? Size of opportunity for this startup. What is the size of the opportunity? Is there a market opportunity or not? Product and service. What kind of product and service is it? How is the competitive environment? How is it? Is there a lot of competition or less competition? Marketing. Is this startup capable of extensive marketing? After this, additional investment. Will this startup need more investment in the future? And other qualities are distinct. The qualities will always be fixed in this. Now you have to give marks to the startup based on these qualities. So how do you do that? You assign a quality percentage. For comparison with similar startup, you need to find a similar startup, and this relative valuation model is applicable only if a comparable one exists. So find the similar startup, and according to the similar startup, you compare yourself to see where you stand in this quality compared to your similar startup. First, look at the strength of the team. I saw my similar startup. I just made up an example. Look at this. My similar startup. So according to it, the strength of the team in my startup is 110% because we are assuming theirs is at 100%. The strength in my team is 110% compared to theirs. Size of opportunity. They have, since it's an older startup, they have more opportunities. I have fewer opportunities. Whatever opportunity they have, I only have 70% of it. Product or service. See, my product is better than his. My product is at 120% of his product. It's a healthy competition in a competitive environment, and we both face the same competition. So we both are at 100%. Marketing, he is better at marketing than I am. I only do 50% of the marketing he does. Additional investment needs. I will need more investment since I am new, specifically 105% of his. Others. So we both are similar at 100%. Enter comparison percentage for each quality based on a similar startup. Then you give weight to each quality and that weight is fixed. Team strengths weight 0.30. Opportunity size 0.25. Product or service 0.15. Competitive environment marketing 0.10. Additional investment and others are 0.05. You will have to remember these important weights and also their corresponding qualities. What does there mean? What's the most important quality in a startup? Team strength, it's 0.30, 30%. The weight is fixed. Although in practical life these same weights are used with some flexibility, you will use these for the exam. Unless the question gives specific weights itself, then you should use those. Now what you have to do, you calculated this percentage, multiply it by the weight, and you will find out the strength of the team in your startup. What is the opportunity size for your startup? And totaling this gives you the multiplier percentage. It's 93.75. What does this mean? It means that compared to a similar startup, my startup is 93.75% times its value. To calculate your startup's value, simply multiply the similar startup's value by the multiplier percentage. So if its value is 1 lakh and I am 93.75% times that, then my value is 93,750. That's it. In the exam, the question will say, following are the qualities of a startup you need to evaluate, and will list these quality names. For them, it will provide the quality percentage comparison as shown. The fixed weights aren't given, apply them for the multiplier percentage. You'll get the startup value completing it. Now let's see next method. This method calculates this in the first step. Then the startup's value is derived. Next, the first Chicago method, a very easy cash flow model. While these models are for larger companies, there's an exception. They calculate expected future cash flows differently. Why is it called the first Chicago method? Because venture capitalists invest in startups. We see this in the startup financing chapter. Venture capitalists are people whose business is to invest in startups and after a certain time exit the startup with a return once it has grown. That's the job of a venture capitalist. So there was a venture capital firm called First Chicago Bank. They developed this method, so they named it the First Chicago method. We'll calculate expected future cash flow through an example. For a startup, fixed future cash flow cannot be estimated. Estimate 3 cash flows annually. For a startup, estimate 3 cash flows. What's the first year's worst case scenario cash flow? What cash flows will the startup generate in a normal first year scenario and in the best case scenario? And probability of all 3 scenarios. Calculate the probability weighted cash flow per year. See the example. A startup's cash flows for worst, normal, best scenarios are given for years 1, 2 and 3. First year's 3 cash flows. Probabilities for the 3 scenarios are given the first. Let's talk about the first year's cash flow, as it can be 10,000 with a probability of 0.20, 15,000, 0.7, 25,000, 0.1. According to this, the probability weighted cash flow for the first year is calculated. Calculate for the second and third years. Once you know future cash flows, take discounting rate according to FCFF or FCFE. Do the PV to get the value, and that completes the entire method. What an easy method. I told you before, it's very easy. Just for each year, that is for every year. For each year, probability weight the 3 scenarios cash flows to find a single expected cash flow. It's like cash flow model. The next method is the venture capital method, the last method for startup valuation. This method is generally used by venture capitalists to determine a startup's value. The venture capital method will operate in 2 steps. Look, the people who are venture capitalists. This method is cash flow based model. Venture capitalists, what is their point of view? When they invest in a startup, on that very day they decide when to withdraw their money from it. That is called exit time. They think to withdraw the entire invested capital after a period of 5 years, diligently calculating the expected growth and future value. So the first thing they do is estimate the value of the startup at the time of exit. What will the startup's value be at the planned exit? If they want to exit after 5 years, then find the startup's value for that 5th year. The estimated value will be given directly in the question or indirectly as the startup's EV upon EBITDA multiple after 5 years. Given the EBITDA multiple and 5-year EBITDA, find the EV. Say the multiple is 5, okay? The EBITDA is 1 lakh after 5 years. The startup's value after 5 years will be 5 lakh. You found the exit value. While estimated practically for exams, it's provided. Second, calculate current value. Prior value was for year 5. And we need the value 0 time. To find the present value of that future amount, we use the investor's required return. The venture capitalist decides in advance their required return, like 1, 2, 3 or 4 times the amount. Venture capitalists demand higher returns from startups due to their higher growth potential. Suppose their required return was 40%. Then take the 5th year's PV factor and calculate the value. The PV of 5 lakh is 93,000. There is nothing to this method. You just estimate the value of the startup according to you at the time of exit. Time of exit means when the venture capitalist wants to exit. It will be given in question directly or indirectly as explained. In the second step, calculate the startup's PV using the given venture capitalist's required return. This method is complete and you have understood how easy these were. The whole chapter is very easy if studied correctly. I have revised all the concepts. Read the notes, they are free to everyone and class attendees already have them. For those watching on YouTube, the complete notes are freely available and you can download these free resources from the website air1ca.com. Need notes or question bank? Use the website. If you get them from random places or from other sources, as we don't make them available elsewhere, or you took it from another Telegram channel and not our channel, if it's from another channel, it's your responsibility. Because you pick up anything from anyone and what they do is, they change the cover page and paste old notes and question bank material. Many students face issues. Then they blame us, but it's their fault as they want free material. If you pick up free material from anywhere, at least use it from an authentic source. On air1ca.com, notes are free in the resources section. Download and refer to them. At home, go through all questions in the question bank. You will solve them easily. The students who took the class, I have solved all the solutions for you in detail in the class. Refer to them along with this and revise from them. You won't face problems. Students watching on YouTube, please first try the solution. Solve it using my method as given in the notes. Then match the solutions from the question bank. In question bank, it's institute solution. Let me just once tell you some special questions with certain points in the question bank where you get stuck or make mistakes. Look, there is one question. In this question, you are asked to find value by net worth, meaning net asset value, and adjust for current land and building value. Calculate SBL company's average PAT for the next 5 years. The calculation is for SBL and ICL's data serves only to waste time. It's of no use in the exam, it's just there to confuse you. Regarding SBL's net assets, which fundamentally represents total assets minus liabilities, you have to specifically account for the share capital plus reserve and surplus. You take its share capital plus reserve and surplus, which is specifically given here as 785, and you can easily verify this. Adjust to current land and building value. The land and building of SBL were revalued 3 years ago, and their value has increased by 30% per year. Increase book value 30% annually. SBL's property 190. What will be the 3-year effect? The future value interest factor for 30% is given. Apply this. So look, the solution I showed you, let's do it on that. So you see they took this initially. Share capital plus reserve and surplus. We must account for the land and building value increase as the question directs. Land and building's current value versus book value shows increase. Besides this, it's said that you have to add. Now let's determine SVL's estimated average profit for the upcoming 5 years. The question states SVL's profit will grow 15% per annum each year. The current profit is 250. So find out the profit for next 5 years and do average. The profit for next 5 years will increase by 15% each year. You will keep increasing and totaling it, so FVAF is required. FVAF for 15%, 5 years given. 5 years. Applying this to 250 crore profit yields 5 years total profit. Average the next 5 years, divide by 5, then add. So this is what you get. Value of equity is derived because both these methods are equity based. Calculate equity value per share, then determine market price premium. So market price that exists today, compare with that and state the premium percentage. Next, this question asks for the dividend growth formula, and it states that SVL is expected to grow at 18% each year after. The merger's 18% growth is useful for D1 divided by KE minus G. So D0 is given in their question. SVL's D0 is given as 125 crore. D0 is of 125 crore. This is total amount given, so you can calculate per share by dividing the total number of shares. It comes to 10 rupees. We need it per share. So you've dividend D0. We need D1, so to add the growth, which one? They expected 18% after the merger. This gives D1 growth rate. CAPM data is unavailable. Second priority, D1 divided by market price times 100 plus G. For the growth rate, you should use the current one. The question mentions SVL's current growth rate as 15%. Based on 15% D1 current market. That gives KE. Now the formula is given. We determine equity per share premium. Alright, with this, your question is complete. It's a very easy question. It just looks big. And we did it in a very normal way in the class. There's nothing special in it. For this question, its initial part applies the earning capitalization method. The question asks for the business's normal value and only earning capitalization applies. The second part requires the shares market price. It's part of the same question, so don't repeat earning capitalization. In this part, the PE ratio is given, which means you must apply the PE ratio model for the second part. So I've told you this. Let's look at the most important questions of the special cash flow based model. All data is provided in these questions and I've done cash flow estimation in class, so we won't fully revise here. One important point, capital expenditures are offset by depreciation. It's being said that the initial period has high growth and this growth phase lasts for 4 years. After that, the growth rate stabilizes. That means in future growth stabilizes, so no new special growth rate applies. When capital expenditure and depreciation offset to zero, what happens in this phase? The net capex will be zero. In such questions, you add depreciation minus capex. For the initial 4 years, calculate cash flow easily. But when you calculate the cash flow from the 5th year onwards, you will make a mistake somewhere. Because in that cash flow, you have to make the capex and depreciation amounts the same. Since capital expenditure and depreciation will offset each other, the net capex will be zero. Even for previous years, calculate net capex. Net capex at time 0, 280 minus 200 means 80 crore. Growing 80 crore always yields combined growth for capital expenditure and depreciation. So the net capex should be grown at this rate. Let me show you the solution how we have done. First, WACC wasn't needed, yet we calculated it. Then for FCFF, we needed the increase or decrease in working capital, which was mentioned in your question. Working capital should be 25% of revenue. So find out the future revenue because the future growth is given for revenue. The next 5 years consist of 4 normal years, then from the 5th it becomes perpetual. So you need to find the revenue for each year. With the revenue, apply 25% for working capital, making yearly figures known. In such questions, the increase in working capital isn't given directly. Instead, the working capital percentage to revenue is provided, which you must maintain. Calculate the working capital change for the first year. There's increase of 100 rupees. Second year increased by 120, calculated in same way. Let's come to FCFF. For each year, EBAT tax, NOPAT are calculated. Now for net capex. Net capex at time 0. In the base year information, what was the net capex? Capex minus depreciation 80 crore. So at 0 time net capex was 80 crore. We have to grow it every year. How much growth in net capex? Here it is 20% for 4 years. 80 increased by 20% is 96. Increase 96 by 20%. Many mistakenly believe that when capex increases, only the incremental amount is taken, like 16. This is not the fixed asset balance from the balance sheet. It tells us how much capital expenditure we do. Next year we will increase it by 20%. 80 plus 20% means we do 96. The year after that we increase another 20%, understand that. In the final year, it was offset and zero. This working capital adjustment gave us the FCFF. Now calculate the value which our full solution yielded. Solve such questions this way and also remember. There is one point in this question. The WACC is calculated separately for the stable and high growth periods. For the stable growth period, calculating PV of perpetual cash flow. In the stable growth period, see what we did. That's why I made this table for you. The balance is found at the 4th year's end because the perpetual cash flow begins from the 5th year. It starts from the 5th year. From the 5th year, for the stable growth, use that discounting rate of that time. We took that WACC and the value will be for the end of the 4th year, which is the terminal value. We'll bring it at 0 time. Now this value, the terminal value, is for the end of the 4th year. It is necessary to bring this terminal value back to time 0, and this is specifically for the high growth period. Take its discounting rate. Use the high growth period WACC, it has 2 vacancy. You must take it because the discounting rate corresponds to the cash flows timing. Remember, I have explained this to you briefly, so you'll recall it. Next, there's a good question. It's very easy, but it looks big. In this question, future sales are given. Future expenses. The future depreciation rate is mentioned, then prepare a depreciation table. Calculate the amount to opening balance, plus you will do capital expenditure every year. That is told to you at the beginning of the year. Depreciation will be charged as its WDV method, each year's depreciation. You are given capex and working capital is 20% of revenue. So from the given yearly revenue, take 20% and maintain it as working capital. Working capital at the start is current assets since no liabilities exist. You will calculate the working capital change. With the rest of the data, you will get the value of the firm from FCFF and then you are asked to find the value of equity. So deduct the value of debt. If there is any cash, add it. So debt is given but no cash is given, so just adjust this. And we have solved this in a very similar manner. We calculated WACC. For FCFF, any necessary information like depreciation was calculated beforehand. We had the opening fixed asset balance, added the new assets and then charged depreciation to calculate the year's closing balance. It's opening of next year. We've calculated depreciation of each year. To calculate working capital changes, you have each year's revenue and initial working capital. Then maintain it at 20% of that year's revenue. Working capital changes with decreases are calculated. So according to this, just deduct all expenses from sales and you will get EBITDA. Tax deduction gave no PAT. Depreciation and capex are calculated separately. You can calculate net capex. It's better to apply plus depreciation minus capex because the answer remains the same. The institute also do same. Also the effect of increase in working capital. PV calculated, then value of firm. Firm's value less debt gives equity value. This question applies your entire concept in detail. Alright, there is this one question, and in this particular question, the biggest mistake that students make is the share value is asked. Find the value per share, okay? Which method we should apply? Looking at data, you'll understand its cash flow model. Now students get confused between FCFF and FCFE. The debt ratio is given, so with debt ratio you can apply FCFE. You have asked for the value of a share, not the company's value, and this share value is directly obtained from FCFE. If the debt ratio was absent, we would apply FCFF and adjust for given debt. But it's given directly. Additionally, as only share value is requested, not total equity, you can calculate FCFE on a per share basis. FCFE per share gives direct equity value. For total free cash flow, calculate total equity value, then dividing by shares gives per share equity value, and this is an option. Second point, the biggest mistake students make in this question by using their own logic is, look, capex per share, depreciation per share, and working capital per share is given to you here. So there are some overly smart people who think they have gained knowledge. The people who misapply their knowledge do so here. What do? They typically say that the capex and working capital change per share is provided. So we don't need the debt ratio, right? It has directly given the share of equity holders. Understand, per share means dividing by total shares. Capital expenditure is divided by the number of shares. To get it per share, the data hints at this. Take FCFE per share and you will directly get the value of equity per share. This does not mean it's the share of equity in capital expenditure. Learn the meaning of English wordings a bit. Learn to interpret the wordings because a slight change can change the interpretation. Here per share indicates the amount was calculated per share by dividing by the number of shares. It is not written here, share of equity in capex. Equity's working capital change isn't written. Per share means divided by shares. This total includes both debt and equity shares. Multiply by 1 minus 27% debt ratio. This has to be done. Alright, so I taught you this question in this manner. Now regarding the strategy question, a company aims to implement a new strategy for sales growth at 20% per annum for 3 years. From the 4th year onwards, the cash flows will stabilize and become fixed, meaning there will be no growth. Net profit ratio, asset turnover ratio, and income tax rate. Those ratios remain constant for the future. Why? For capex and working capital changes. That's not informed in this question. Every question says that working capital is maintained till here. So you will calculate that using this data, okay? Depreciation is stated to be 10% of net fixed asset balance at beginning following the WDV method. Company's return is 15%. Calculate the strategy's incremental value. Now let's review the solution. Look, first of all, in this question, is there debt recorded anywhere? Because no debt is given, so the PAT becomes no PAT. FCFF will become FCFE, and we need FCFF since strategy's value represents the firm's value. Remember this point. So PAT became no PAT, which I have also mentioned in the solution we did in class. Calculate the existing ratios, PBT, PAT, fixed asset turnover ratio, and current asset turnover ratio. We calculate these ratios using the provided formulas because they will continue in the future. The calculation is based on it, and the PAT ratio was 7%. I've told you how future sales will grow, so you get the sales for each year. Then applying the PAT ratio gives you the PAT, and we know PAT is no PAT for this question. Notes cover everything if studied properly. Alright, so we got the no PAT. Now we need capex, depreciation, and changes in working capital. For this, we'll first determine future sales, which are essential for our calculations. For the next 4 years, it will grow for 3 years. From 4th year, it will stabilize, means there is no growth, it will remain same. Next, we will find the closing balance of fixed assets for each year, and we can do this by using the asset turnover ratio that has been provided. It's known. These ratios are consistent and their formula is turnover divided by fixed assets, the asset turnover formula. So 2.5 ratio is coming. So you know the future turnover for each year, and if you put the data in that formula, you will get the closing balance of fixed assets for the next 4 years. So we have got this. Then we'll make a fixed asset ledger account. Is the opening fixed asset balance given? Yes. The first year's remaining balance. Depreciation, apply 10% on opening balance. What's left? Capex, the balancing figure. What else? This is your Capex. Same you can do for second, third and fourth year. In the fourth year, Capex depreciation, it will automatically be 0 because there is no growth, and the logic I was telling you will also be verified everywhere. Increase, decrease in working capital. The current asset turnover ratio is applied, and because there are no current liabilities, that itself will be used. So in current asset turnover ratio, here, if you input the sales data, you will get the annual current assets. Current asset is working capital as you won't have other data. You know the current assets at time 0 and have found the future, giving the change in working capital. From the fourth year, the strategy's growth stops. The increase decrease became 0. So with the FCFF, you can now calculate the value of the new firm. This determines the firm's value from the new strategy. Strategy's existing value and no PAT equivalent to PAT. I told you the reason, divide by your existing. Discounting rate is 15%. The existing value came out negative. Means strategy is bad. Your question is complete. The special equation I mentioned, the institute uses per share earning value of the company. Apply the earning capitalization method, deduct given profit and expenses for your FMP. There is no future plan. We got the FMP. Now what do we need? We need the discounting rate. Is the capitalization rate given in the question? No, it is not. So you will assume WACC. For calculating WACC, we need KE and KD aren't given, but risk-free return is provided. You are given the market return. The beta of the company, which is the asset beta, has been provided. Is KD etc. given anywhere? No, so WACC cannot be calculated with the normal formula. You calculate WACC using this formula. Remember, I've made you write everything in notes. Apply everything given and get the answer. Then you will get the value of the firm, the earning value. For per share earning value, should we directly calculate it? Now use your brain. If it says per share, should I adjust for debt, cash, calculate equity value and then make it per share? That would be your foolishness. You have to follow the foolishness of the institute. This is the institute's mistake. Now don't add your own foolishness to it. That's all. So this earning value per share. Now let's move on. There is nothing else in this question. It's a normal question for today. This is your CCM approach, the comparable companies method. There are 4 ratios given for 2 companies, SK Limited, AS Limited. So you know all 4 of their ratios. Average of 4 ratios was done as of 2 companies. And you applied these 4 ratios to your own data on all this data of XY Limited. 4 SK Limited values are known. The average of 4 values is final. We completed the stepwise solution in class. See that. I have explained it to you like this. This is your breakup value approach. It's similar. Besides this, look now this EVA question. This is EVA question. Look at this. In this, there is a special point. In this question, KD is given. Okay. RF is given. Market risk premium RM minus RF was covered during CAPM. In chapter where CAPM is discussed, asset beta is given and it is beta of TSR. RM minus RF, RF and beta are given. Calculate WACC from here? No. The cost of debt KD is available. Do not take a shortcut when KD is available. This method is invalid. Now you have to use your brain. Your company is STR Limited. You are given the asset beta of TSR. Remember portfolio chapter. In the portfolio chapter, I explained how to find the equity beta of an unlisted company. It finds the asset beta of a very similar company and considers it its own, and gives an equation for asset beta, beta of equity into weight of equity plus beta of debt into weight of debt. Inputting values into this equation yields equity beta. If forgotten, check the portfolio chapter video. I explained this in detail with logic. A similar company's asset beta is provided. Assume it's yours to calculate equity beta. Once you have equity beta, you'll get your KE. It's a pre-tax interest rate. After tax, it will give you KD. You will calculate it from WACC. We have reviewed this financial leverage question. And now I'll show you its solution. There was an interest expense. We applied the financial leverage formula, inserting data with E by T blank, then solving the equation. I also taught a direct method derived from that equation for direct calculation. Your choice. Next, we have a special question. in which it is stated that a patent is not recorded in the books. 40 lakh. It is not recorded in books. So where do we account for its adjustment? This is a question to calculate EVA. Does it affect NOPAT? No. It's in the invested capital. You should add it. Besides this, there is one more place for the adjustment, which is the WACC. Remember, for the weight of E, its value must include equity share capital plus reserve and surplus, and the intangible assets which are not in the books. Remember that there. Here the cost of capital is provided, and if it wasn't, you would make that adjustment. Similarly, the next question is of the same type. Now you can listen here. I'm highlighting the point where you will make a mistake in a hurry, because no matter how many times I explain it, you still might not listen. This question gives DY Limited's market value and asks for the market value added. For DY Limited, the firm's market value is given. To calculate MVA, which formula applies? Market value of firm invested capital. So we will apply that. Okay, after this, next question. The firm's market value is provided. And deducting the invested capital, you'll calculate MVA. Okay, I will tell you one more point in this question. This question involves a non-cash adjustment for bad debts provision. This adjustment will be in NOPAT, so you've added in NOPAT. The adjustment affects your invested capital, which you've already added. What we often do in hurry is with this adjustment for WACC, particularly concerning the weight of equity we use. For the weight of equity for WACC, in the value of E, we take equity share capital, reserve and surplus. Unrecorded intangible assets are to be taken. In a hurry, we think to include non-cash expenses. Because in the question, this EVA question involves non-cash expense adjustment. Don't make a mistake, ensure it is placed correctly. The non-cash expense adjustment was here because this firm had registered the adjustment. WACC is generally used by the whole world. There is no non-cash adjustment there. For the WACC, let's see what the value of your E actually is. How much will it be? Share capital, reserves and surplus. 800. And how much will the debt be? 100. So for WACC, the total will be 900. Students often assume 900 here, 920 there. These concepts are incorrect and your teaching was wrong. Or you don't have enough knowledge. So you have to correct it. One last important point in this question. In this question, you are asked for MVA, but market value of firm is nowhere. Given, you can check the entire question. Instead, you are only provided with the current market price per share. The firm's market value isn't provided. Students claim methods differ and you should read the question. They don't want to read the question and blame the method for being wrong. Here the market price of the share is given. So what will you do? You can calculate the market value of shares. You cannot get the market value of the firm now. So take market value of share. Calculate the market value of shares, 50 per share by total shares. What you have to subtract? The book value of shareholders, which is shareholder equity, is share capital plus reserve and surplus. Don't deduct the invested capital. In this question, the MVA, calculated using equity's market value and shareholder fund. This MVA will come. These were some special points from the questions which I have told you, and I have revised all concepts. I have also highlighted special points in the questions where you can make mistakes, and the rest was general. So we have almost revised the questions as well, because these were major things. So now revise it well. If you have any doubts, let me know, and whatever you thought of the video, if you liked it, do let me know by commenting or tell me, by sharing your feedback, because I always say when you tell me that you liked it, I also get motivated. I feel like working harder even more for you all. If you have any doubts, you can ask in the comments of this video or message me. If you like it, you can recommend and share it with your juniors. That's all there is to it, so please refer to the notes and check the questions in the question bank. Class students should refer to solutions for revision and YouTube viewers should solve it themselves. Then match answer from question bank. Let me just make one point. YouTube students, please don't start commenting or messaging me with this. I make students write the solutions within the class itself because they are not available separately and won't be in future. If you have taken the class, you can write it in the class, you can practice. So please don't message for that. I am saying no in advance. There is no point in you messaging for it. That is not possible. So that's all for today. Thank you so much.